right, welcome everybody to the sixth and final day of the TraderLion conference. Thank you guys so much for tuning in. We're going to end things off with a bang. Today we've got a fantastic group of presenters. Starting at 9, we've got Pavel Kycek discussing algorithmic trading strategies for cryptocurrencies and discussing kind of algorithmic trading and quant-based trading as a whole and as a concept, and providing a lot of excellent examples that should be really good. Looking forward to that, as well as the Q&A. Then at 10:30, I'll be presenting key lessons for market wizards. At 12, Eric Krull will discuss IPO and growth stock trade management and the lifecycle advantage. And then to close things off at 1:30, we've got, last but not least, Peter Robbins and Agnieszka Wood discussing empowering traders through strategy alignment and self-control. These are going to be fantastic. You're going to want to watch all of them and stick around until the end. So hopefully you guys get some more golden nuggets today. A few quick things. As always, again, we are able to do this for free, but we do ask in return that you help spread word about the conference and click the link right now showing up in the chat that allows you to tweet out the link to the stream. We'd really appreciate it if you do that and help pay it forward and spread awareness about the resource that we are building here. Also, I just want to thank our sponsors quickly. We've got DeepView, of course, the tool that we're creating that is the best thing out there for swing and position traders in terms of screening, watchlist management, charting, all of that. Then, of course, StockTwits, as well as interactive brokers. If you want to support the channel, a great way to do that is to click the links popping up right now in the chat and checking out our sponsors. I always get this question. I think I will again today here in the last day. Will it be recorded? Yes, it will. You can access today's streams, at this exact same URL, scroll back in time whenever you want and rewatch any presentation that you would like to. And this is the same for the prior days. You can go ahead and look at our channel, click live under videos, and you'll get access to all the different streams. We've actually got a playlist where we're combining all the different resources associated with the conference all together to make it easy on your end. So if you do see somebody ask, is this being recorded in the chat? Please let them know that yes, it is. How to get the most out of the experience. First of all, please go ahead and subscribe to the TraderLion channel. We worked really hard to put this event together, and we not only do this every year, but we also have podcasts with top traders where they share their strategies, setups, go over trades, both winners and losers. We've also got, webinars, tutorials, all of that. You don't want to miss that. It's completely free. Go ahead and subscribe down below. We're trying to hit 100,000 subscribers. You can help us get one step closer to that. And then the other key way to get the most out of the experience of the conference is to join the VIP via the QR code right here. And this allows you to download the slides, access additional material, notes for each presentation. We'll be adding those. And it also gives you access to all the free resources on the TraderLion University, which includes model books, the ultimate trading guide, the conference resource, the podcast resource that we're building, basically some amazing resources that can help you improve your performance and shorten your learning curve. So definitely go ahead and do that. Again, it's 100% free. Then I'd really encourage you guys to engage as much as possible with the chat and with others. That's a great way to stay engaged and, make sure you're actively listening. Then, if you have some great notes, key takeaways, share them with us on Twitter. Tag myself at Richard Moglen or at TraderLion on Twitter. We'll retweet them and, help spread the word as well. And then, as I mentioned, you can scroll back at any time and rewatch your favorite presentations. Maybe the first time you're not taking notes, you're just kind of listening. Then the second time you do kind of a deeper study of each of the presentations. Here is some of the free resources that I mentioned. We've got the model books, Price Cycle Mastery with Oliver Kell, the annual trading conference, the TraderLion podcast resource, as well as the ultimate trading guide. Again, you can scan this QR code and you'll be put right there. Very easy to sign up and 100% free. And these are amazing resources that can help you learn the template for trading success. You can study, top traders, top stocks, and also, so much else here on the TraderLion University website. Also, we're really excited, and I want to make sure you guys are aware of this resource that is upcoming on August 24th. We'll be doing a TraderLion webinar with Jason Shapiro. You heard from him last weekend. He is a market wizard featured in the latest Jack Schwager's book, and he's got a very unique contrarian approach with COT data that can really be a helpful edge for whatever your trading strategy currently is. And he'll be sharing his exact approach and strategy, as well as discussing key trading principles such as risk management that really provides that additional edge that has allowed him to be a market wizard. So you don't want to miss that. You can get the early bird via the link that's right now in the description and chat. And spots are limited to only 500 live participants. They're going pretty quickly, so make sure you register and get your spot today. Also, another great way to pay it forward for this conference is to consider a donation to St. Jude's. We just crossed the 10K mark yesterday in terms of donations, which is amazing, but let's try to even surpass that today. You can basically use the link below in the chat. You can click the blue donate button. Even $1 is great, $5, $10 is fantastic. And make sure to tag us on Twitter if you do so, and we'll go ahead and thank you personally. And thank you guys all for everybody who's already donated and is currently, donating right now as I speak. Also, one last reminder to go ahead and subscribe to the TraderLion channel. As I mentioned, we've got the TraderLion podcast, tutorials, free webinars, key clips. You don't want to miss this. And we've got a goal in our sights of 100,000 subscribers, which would be amazing to hit. And you can help us get there. If you're not already subscribed, what are you waiting for? It's completely free and you get access to amazing resources. So go ahead and subscribe today. And with that, we've got a great group of speakers, as I mentioned, starting with Pavel. So thanks so much for joining us again. Get your notebooks ready, and we'll be right back to start off the day. So thanks so much, and I'll be right back in just a minute. Take care. Okay, welcome back everybody to the TraderLion conference. I'm super excited to be introducing our next presenter, Pavel Kycek. He is a fully systematic trader with over 18 years of experience, and his specialty is algorithmic strategies in stocks and cryptocurrencies. This is a presentation I've been really looking forward to personally. Pavel, thank you so much for being a part of this, and looking forward to diving right in and asking you a ton of questions as well. I'm going to really enjoy this one.
Hi, Richard. Thank you. Thank you for having me here. And yeah, let's jump on it.
Let's do it.
Okay, so let's go to algorithmic trading and crypto and how to put everything together, because I think most people are making many mistakes regarding to algorithmic trading and regarding to crypto investing and crypto trading in general. So let's cover it. Firstly, some disclaimer. Of course, some of those results are backtested one. Backtested results are never the same as the real ones. And keep safe and always stick to your risk management. So my first message is don't invest in crypto. I know that it's pretty strange because we are talking about crypto trading, crypto investing here. But really, what I'm always trying to say is that investing, and by investing, I mean long-term allocation of capital into different crypto projects, is usually the worst way how to get allocation to crypto. Why? Because if you compare, for example, S&P 500, the stock index that everyone knows, to S&P crypto since 2018, you can see that the performance is more or less the same, but with huge volatility. Of course, if we would start here, the performance would be higher, but the main message is that crypto is not an investment asset, and it has its reason that we will cover a little bit later. One of the main reasons why not to invest into crypto is that most of you, and I mean really most of you, wouldn't be able to withstand drawdowns of minus 85% or minus 80% or another minus 80%. It's just huge. And by my experience, I know that a drawdown of minus 40, everything between minus 20 and minus 40, is usually not able to go through during live investing or live trading, because going over these results on the chart is totally different than to live through these movements. So really, don't invest, do it slightly different. Why not investing? I really like this table, because if you want to compare some assets, some trading approaches, some investment approaches, you have to have some basic comparison that you can use across all the asset classes or these investment approaches. What I often use for very first comparison is basically a risk reward table, which is giving us the ratio between annual return and drawdown. And if you divide your annual return of the asset or the strategy by the maximum drawdown, you get some ratio that you can start calculating with, and you can start comparing this ratio between each other. Here, if you compare S&P 500, just buying and holding S&P 500 since 2018, that's the time when we are starting having good data for crypto too, to buying and holding S&P crypto, you get much worse return to drawdown ratio compared to S&P 500. Why? Because of this huge maximum drawdown. In fact, if you would like to get to the same ratio on crypto to S&P 500, the annual return would have to be at least 26 or 27% average, which I'm really not sure that crypto will be able to deliver such a huge return just by buying and holding over the long term. Plus, what's even more important is that drawdown or volatility is just one of many potential risks. In fact, you should add here many more risks that crypto is still full of. So really, this is, let's say, the basic information, and we will start building on this table later on. Why we are in crypto, why we trade crypto for our clients, for institution and retail clients, is crypto volatility, not long-term trendiness. It's super important, because compare the blue line here, which is basically ATR 14 of S&P crypto, to S&P 500. Again, I like these comparisons because it is really giving eye-opening view on crypto in general for those that are not that familiar in crypto. You can see that the difference between S&P 500 and S&P crypto is between 300% to up to 1,500%. So the volatility on average over the last 5 years is about 800% or 9x. And this is the reason why we all who like trading should be in crypto, because volatility is the key, that's the main driver of potential profits. So this is something that is extremely important to understand, and it is something that we should think about if we are building our strategies, if we are building our projects. Now, what's volatility? Just for all of us to know, volatility basically is unit of movement. The higher the volatility, the better for us traders, of course. And what's even more important is to understand the basic characteristics of volatility. And these are two main ones. The first one is that increased volatility tends to remain increased. You can see it on this chart. On the y-axis, you can see the day-to-day volatility, and here you can see the years, basically days. And you always have periods when the volatility is much higher, and those periods are always followed by periods when the volatility is much lower. And it's always changing. The periods of high volatility are followed by the periods of low volatility. In fact, this is the only 100% market cycle that you can bet on, that after periods of low volatility, there will be always periods of high volatility and vice versa. And the second fundamental characteristics of volatility is that increased volatility tends to create at least short-term trends. This is something that we can bet on over the long term. What it means that usually if we have some initial point of view and the market, there is some news, let's say, on the market, and there is some increased volatility. This increased volatility, with some probability, of course, usually pushes the price into some following volatility and following trends. And based on these two fundamentals, you can start building your trading models, because your trading models always have to consist some fundamental condition that is based on the main characteristics of markets in general. So volatility is the key everywhere, especially in crypto. Now, another thing is that we should know the main reasons or the main differences between long-term trends and short-term trends, because long-term trends, very simplified, are about value. It's about expecting higher value in the future, especially if we are talking about stocks. But these short-term trends can have many triggers, which is key. It can be herd behavior, this can be manipulations, or even different pumps and dump schemes, especially in crypto. At the end of the day, doesn't matter. What we have to know is that long-term trends are about value and the growing expected value, and short-term trends can have many triggers. And you can see it on this chart again. The blue line, S&P 500, you can see perfectly nice long-term trend. Compare it to S&P crypto, you can see many short-term trends to the long side, to the short side, to the long side, to the short side, then some flat, and then to the short side again. But these are definitely not long-term, definitely not in crypto, because there are too many projects that are not delivering value. They are trying to find some value, but they are not delivering it. And that's why these long-term trends are super volatile and they are not that smooth. We should bet on short-term trends more than on long-term ones. Now let's get to very first trading model that I really love, because it is showing the strength of algorithmic trading on crypto, and it is showing the inefficiency of crypto market in general. This trading model is very simple. It's only about buying Bitcoin. Right now we are talking only about Bitcoin. If it is closing above its moving average 50, and we close the position if Bitcoin is closing below its moving average 50. Let's see that we have some chart, we have some moving average, and if we close above it, we get into positions and we stick with the positions as long as Bitcoin is above its moving average, and once it is closing below, we are getting out of this position. And if you compare just buying and holding Bitcoin to this very, very simple trading model, you get the overperformance of 7x or 600 to 700%, which is huge. If you compare it to stocks, for example, these very basic trending models would give you probably underperformance to just buying and holding because of efficiency of traditional assets. The less the asset is efficient, the more these very basic trading models will deliver overperformance compared to just buying and holding. So it can be even your basic comparison among different kind of assets or asset classes. But it was only about Bitcoin. And I don't like this example because of one reason, and it's because of selection bias. Honestly, selection bias and hindsight bias is something you wouldn't even believe how many even professional traders or capital allocators are suffering from. They just choose Bitcoin, Ethereum, Solana, let's say the most known ones, and they put some very basic trending models on them, and they are showing these results from the past, and they think that they would be able to deliver these profits to the future. But it's huge nonsense, and we will get there a little bit later. But what's very important to know is that the more the asset is inefficient, the more the hindsight bias or selection bias is problem for traders and for real results of the trading model. So let's get to one very simple trading model that most algorithmic traders know, and it is rotational strategy. The idea is very simple, and it again consists only of three conditions. One is context filters. It means that we are filtering the market into phases when we want to enter into positions and to phases when we don't want to. So our context filter is the one that we have used on the example below, which means that we are entering to positions only if Bitcoin is above its moving average. If it is above its moving average 50, the context filter is switched on and we can start trading. And we only take trades on 10 coins that are the most trending ones based on rate of change 30. So we enter into these positions and we stick to these coins as long as these coins are in this top 10 positions by the trendiness. And once Bitcoin is below moving average, we are not trading. And as long as it is below, we are just rotating the 10 most trending ones. That's simple. Let's say that's very simple strategy that is even working on stocks, that's working on commodities, doesn't matter. But what's important is to check the performance. We are talking about, let's say, 18,000% since 2019, 2020. Why? Because we are taking advantage of this huge volatility of smaller projects and this short-term trendiness. That there is no magic. This strategy would deliver the performance of 10 to 15% on stocks and about 100% to 150% on crypto. The main difference is the volatility of crypto in general. Because if we get back to this risk reward table and we calculate our ratio, we are getting to 1.6x. It means that the historical drawdown or the annual return is 1.6x higher than the maximum historical drawdown. So we are getting onto something. It's super volatile solution. You wouldn't want to go through this phase for sure, but we are getting a model that is able to deliver annual return of 100+%. Of course, 70% drawdown is still too much, but it's still very simple one trading strategy. Now, how is it possible? How is it possible? We have to break it here for a bit to even more understand, especially to those that are not trading crypto, how is it possible such huge returns? It's all about the immature characteristics of crypto, because once we started trading really professional crypto, I would say we started being professionals on immature to mature cycles in general, because you could see these cycles everywhere over all these trading asset classes. Doesn't matter if it is stocks, commodities, but it's always the same. Firstly, there is period which is about low liquidity. Let's say the asset is pretty low liquid, which usually brings high volatility. Why? Because you can have just pretty small trading sizes, and these are already moving the market quite a lot. This high volatility usually brings big opportunities in terms of trends, short-term ones at least, and inefficiencies. Just inefficiencies on crypto that could be measured by mean reversion strategies are right now 4 to 7x higher, just for you to know. So these big opportunities, what they are doing, they are basically pulling new capital into the market, and this new capital is pushing the liquidity higher. And the higher the liquidity, the higher the efficiency of this asset class, and the smaller the opportunities. And this cycle is everywhere. You can see it on trend strategies on commodities in 1980s. At those times, trend strategies would be able to deliver 40-50% average yearly. You could see it on tech stocks before the tech bubble, for example. These were years that were very, very comparable to current crypto market. So this is something that is always in the market, and you just should or shouldn't based on your state, and you should take the opportunity. One more thing, you could even see that this cycle is already happening on Bitcoin. What these two charts are showing is the daily rate of change in 10 days when the days were higher than 10% or 20%. You can see that in 2017, there were more than 50% of those days, 50%. And in 2023, we are getting to under 20%, which is still huge. But these 20% plus days, these were almost 30% in 2017. Compared to 23, we are getting to 7 to 8%. So just to put it into perspective, this is one of the reasons why I was saying this, that picking one crypto, Bitcoin, Ethereum, or something, and trade just on this doesn't make any sense, because the volatility is just getting lower as the asset is getting higher and is more liquid. But just very quick comparison, look at this chart and now compare it to S&P 500, and you can see that these 10+% days were almost none in last 6 years, and 20% plus, these were only during COVID crisis in 2020. And probably don't forget the results in 2020, because all the models were delivering profits like above average. Why? Because of volatility. That's everything is about volatility. So that's the reason why this trading model is able to deliver such a huge overperformance compared to just holding Bitcoin. Now let's get to some real trend strategy on the whole crypto market, because I think it's even more important to show what algorithmic trading on crypto is in general. We could pick out one of our strategies that we are trading for our clients. This could be trend catcher long. And what it is doing is that it is trading based on moving average 20, all the tradable crypto futures that are filtered based on liquidity. So we are not trading the smallest ones, but we are trading the more liquid ones, let's say top 50 to top 60 most liquid coins. And these are ranked on the daily basis. So there is, again, no selection bias. And don't forget that on this one is pretty high selection bias, because we selected Bitcoin that was performing pretty well over last 5 years. And what we are doing here is that we are just buying coins that are above moving average 20, and we are closing the positions if the coin is below moving average 20, and we are doing it only if the market is in the growing, let's say, characteristics, and it is only if Bitcoin is above its moving average 50. So that's the whole strategy: one entry condition, one exit condition, one market regime filter, and some kind of ranking that is basically telling us that we want to trade the most trending coins only. That's it. And again, look at the performance. And again, why is it possible? Because of volatility and trendiness of the solution. Because what's really important to understand if you are thinking about algorithmic trading and trading models in general is that these models can give only such a performance that the market is giving you. So that's not about magic. These models are definitely not magical. Those are oversimplified, because the more simple, the more robust the solution. So they are really oversimplified, but we'll get there a little bit later. But they do deliver such profits because we are trading them on the most immature asset that we are able to trade right now. Now to key characteristics of a robust strategy, because it is something that every algorithmic trader should aim for. First is logical basis. What it means is that it has to be made on some sound idea that is basically built into the market. We were talking about volatility. We were talking about that the increased volatility is basically pushing new trends. Based on these ideas, you can build many trading models. Another one is simplicity, and that's really the key, because every other condition that you give into the model is exponentially adding the difficulty of the strategy and also the probability of failure, because it's super simple to build some strategy on past data, but unfortunately we are not trading history, but we are only trading the futures data. And that's why the more simple and the more logical the model is, the higher the probability of survival in the live markets. And then there are two even more important points that most traders are not thinking about that much. First is that every robust strategy is profitable only at certain market phase. That's really super important. What it means, if I have trend catcher long strategy, which is basically catching long trends, this strategy will deliver profits if the market is trending. So you can see here, Bitcoin is trending, the strategy is delivering profit. Here, Bitcoin is trending, the strategy is delivering huge profits. But if the market is going to the short side, your models will be flat or they will lose money. Usually they will lose a bit of your equity. And if you want to build one strategy that is able to trade and deliver profits in every market conditions, you will always end up with over-optimized crap. Always. That's super important. And the worst thing that most retail traders are doing is that they are trying to build on the past data some nice strategy that is able to deliver profits in every market regime. And that's really nonsense. And the last point that we covered somehow is that it will bring losses in phases that the strategy is not built for. Again, if the market will be super flat and we are trading trend strategy that needs volatility, the strategy will just lose money. That's it. That's the reality of algorithmic trading. Honestly, that's the reality of almost every trading approach. But most traders are just not thinking about it deep enough to go over it and start building portfolios, which is the key for algorithmic trading, and we will get there. What is also important, that especially if you are building strategies on daily data, you will have losing periods that can easily last for many months, even a year or two. You just won't be able to reduce it by one strategy. You will have to start building portfolios. To build very simple portfolio, let's just go over another strategy that we are trading. This strategy has just horrible equity curve. You definitely wouldn't want to trade by itself. You can see that it's basically flat for 2 years, then it made some money in 1 year, and then it is again flat more than, let's say, 1.5 year. This strategy is the opposite of trend catcher long, so it is only trading to the short side. It is only trading if Bitcoin is below moving average 50, and it's only trading if the coin is closing below moving average 20 and getting out of the position if Bitcoin is if the coin is above moving average 20. You can see that if the market was growing, for example here, this strategy was losing money. Sorry, you can see it here. Market was growing, strategy was losing. Then the market was falling, the strategy was making money up to 60-80%, and then the market started trading to the long side again, and the strategy was giving some profit back. You wouldn't want to trade this strategy by itself, but the value is very, very high, and it's in putting this strategy into portfolio. Here you can see the very basic of portfolio, which is just two strategies together, trend catcher long and trend catcher short. You can see trend catcher long as the green line, trend catcher short as the red line, and the blue line is the whole portfolio. Compare just trend catcher long, for example, in this phase, to the whole mini portfolio that we just built, and you can clearly see that the stability is just thanks to these two models on very, very different level. And we are playing just with two models here. Normally we are trading 10, 15 plus strategies. So just to think about it again, just for some comparison, here you can see our very basic model that is trading on Bitcoin only. Compare it to this trend catcher long short, the overperformance is again 12 to 13x or something like that. Pretty high.
And sorry to jump in, just a question about the combined strategy there. Is that equal allocation between the trend catcher long and trend catcher short? So 50% in that in one, 50% another. You're not kind of changing that as the models change. It's just kind of a flat equal.
That's great idea. In fact, in this particular example, we are getting allocation 100% and 100%.
Okay.
To long and short. Why? Because we do have this regime filter that is basically switching off or on this long versus this short strategy. So yeah, it is a little bit more aggressive. It is more like an example.
Right.
But thanks to this regime filter, you can reuse the same capital for the whole strategy, which is super important and very strong way how to reuse the capital thanks to portfolio trading.
Gotcha. Thanks.
Yeah, you're welcome. So to portfolio trading and why it is key, just very quick sum up what's portfolio for algorithmic traders. For us algorithmic traders, it means trading two or more low correlated or uncorrelated strategies. And it is very important because once you trade correlated strategies, the portfolio strength is basically none. Then it doesn't make any sense. So it's always about correlations of these strategies, because otherwise you can't take the advantage of portfolio trading in general. And what's correlation, just for you who don't know, it's basically a relationship between two variables. If the correlation is high, it means that the variables or our strategies, let's keep it simple, are moving the same way. If the correlation is negative, it means that if one is making money, another one is losing. And if it is uncorrelated, it means more or less that one is making something and the other one is making complete like non-correlated results. So why it is key. First one is something we already catched a bit, and it's better capital allocation, because if the strategies are uncorrelated, especially in drawdowns, you can reuse the capital completely or part of it. Thanks to this, the account is performing much better because you are using the capital more often. So basically you are getting to higher usage of the capital thanks to this higher allocation of the capital. Then if the strategies are made properly, you are getting to higher stability of profits. and you are reducing the risk of single strategy failure, which is something we didn't touch until now, but it's also pretty important because every strategy can fail over the long term, because even though you make it super robust, you make it based on the sound principles, based on the fundamental key principles, basically, your strategy can still fail. If you trade one strategy on your account only, you are basically, you are not in a good position. If you trade 10 plus strategies, honestly, you even, your clients or you on your equity curve won't even notice if you won't go deeper into the portfolio construction and you won't go strategy by strategy. So once you start building portfolio of 10 plus strategies, you are more of manager of more strategies in the whole portfolio, and you can compare every single strategy to their benchmarks, and you can see, this strategy is performing good, I can keep it. This strategy is underperforming more than a year, maybe there is something happening, and you can make some steps, and your trading is much calmer compared to trying to trade one or two strategies when you never know when the strategy will fail. And at the end of the day, probably almost every or close to every strategy will fail over the long run. Now I mean decades. I'm not talking about months, but really decades of trading. So that's very important reason why to trade broad portfolios. Another one is that you are really lowering the risk of over optimization, because if you trade single strategy, you are always pushed to get as much as possible of this single strategy. It's just in us, it's, we as traders want to perform well, and if we want to perform well with one strategy, we are over optimizing it a bit. We are just making this very big mistake, and over optimized strategy is always failing over the long term. And another one is that if you trade more strategies like 5, 10 plus, you are even getting to smaller positions, and the smaller the position, the more you are reducing the risk of single coin or single stock failure or some big drop in your positions. So you are basically minimizing many risks, but you don't have to reduce profits for those risks. This is the reason why many traders are calling portfolio trading or algorithmic portfolio trading as the only holy grail of trading, because it's really possible to deliver nice performance and lowering possible risks. What's true is that if you understand this table, you very easily get ahead of 90%, maybe 95% of all retail traders. And this is correlation table of two strategies. You can see it here. Here we have trend catcher long and trend catcher short, again trend catcher long and trend catcher short. If you look at the correlation in returns of trend catcher short and trend catcher long, it's minus 0.1. It means that trend catcher long is delivering returns if trend catcher short is losing a bit, and the opposite is true for trend catcher short. What's even more important is correlation in drawdowns, because if you get to non-correlated strategies or even negatively correlated strategies in drawdowns, then it really means that you can push the performance higher while even reducing the drawdowns. And that's really the secret of long-term profitable algorithmic trading. Just these, understanding these tables. You can see it here. We have some ROR of trend catcher here, of trend catcher short, and the combined one, and the maximum drawdown of trend catcher long and trend catcher short. And you can see here that we really pushed the performance up while we were keeping almost the same maximum drawdown. Of course, here we are trading only two basic trading models. If we put more strategies, what's happening, more uncorrelated strategies, what's happening is that you can push the drawdown lower while keeping the performance the same. And if you can really trade advanced portfolios of 10 or 15 strategies plus, you can push the performance higher while even pushing the max drawdown lower. And that's something you never ever are able to make by trading single strategy. It's just not possible. Let's push our portfolio slightly further, and let's do it by adding mean reversion short strategies. For you who don't know what mean reversion is, that's basically an approach that is trading against short-term market overreactions. So let's say we have a market that is moving somehow. During one day, it makes some move that is 2 to 3x higher than normal to one side. You basically enter against this move and speculate that the market will mean revert to some degree. It doesn't have to mean revert fully back, but usually after these movements, there are some shorter term mean reverting characteristics of the market, and you can take advantage of it. And that's basically the second sound idea of how to build your trading strategy. First is momentum one based on volatility, and second one is mean reversion one based on market overreactions, or also called inefficiencies. You can see this model here, the equity curve, it's pretty stable. It's also the characteristic of mean reversion strategies in general. Why it is more stable than trend strategies is because we are in positions just few days, 1 to 3 days in general, and we don't need massive movements like in trend strategies. We just need 1 to 2 days overreactions when we enter into, and we are usually getting pretty high probability of profits between 55 to 70% compared to trend strategies that have the probability of profits of 35%, but the average win rate or the average winning trade is much higher compared to the losing trade. So let's take this strategy and put it to our portfolio of trend catcher long and short, and you can see the comparison here. The green one was the original portfolio of trend catcher long and short only, and the blue one is with our pump and dump or mean reversion short strategy. The main difference is that it is giving stability in the markets when there is like non-movement, or the market is not moving that much, the volatility is lower, and this strategy is extracting money just thanks to these inefficiencies, not thanks to trends. You can also see it here that is keeping the maximum drawdown slightly smaller because trend strategies were basically giving back some of the profits. This mean reversion strategy was making some money, and that's why it was keeping the drawdown lower. And of course, we'll always have drawdowns, even though we will trade 50 plus strategies in the portfolio. So this is with mean reversion short strategy. And once again, just shortly to the correlation table, what's important is to compare our new strategy, which is pump and dump, to trend catcher long, because this is the one that is making the most profits here. And thanks to adding this pump and dump strategy that is only making 17% per year, which is not that much. It's pretty low performance on crypto, honestly. Just by adding this strategy, we pushed the whole portfolio to 220% with a drawdown of 47%, which is again almost the same that just one strategy delivered. So that's the key of portfolio trading. Once I have more strategies, I can think about my targets. If it is lowering drawdowns or pushing performance, then I can really play with weights, as you, Richard, very rightly asked. Then I can really think about the target. Is it performance? Is it volatility of my trading account? At the end of the day, it is then more up to the trader and what they want to get from their trading. And just to sum it up, how you could push the idea of portfolio trading even further, because I'm really talking about portfolios because I think that's the key, and I think that not many retail traders are thinking about that much, and they should much more than about single strategy, because portfolio is the key. How we are, for example, building portfolios is that we are building sub portfolios first. Let's say we are building some sub portfolios of long trend strategies only, short trend strategies only, and then we put it into trend only sub portfolio, which is the blue one that is again built of long trend strategies and short trend strategies. Just for you to know, long strategies here are from 6 trend strategies, and short strategy sub portfolio or short trend strategy portfolio is built of 3 strategies in this example. Of course, we will still have drawdowns. Why? Because if the market is not trending, we cannot make money with trend strategies. But that's why we also have mean reversion sub portfolio in the whole portfolio. And that's something you should always have in your portfolio. Why? Because especially if you put more mean reversion strategies into the whole portfolio, these strategies are really pushing the stability much higher. Of course, the profit is much smaller. Just compare it here. The mean reversion portfolio is about, let's say, 500%, and the trend portfolio was up to 20,000%, which is huge, but it's just crypto, you know. On stocks, it's the same, but just much more results. And if you put these strategies, this mean reversion long, mean reversion short, trend long, trend short, to the whole portfolio, you are getting results or performance that is not possible to make by single strategy on any asset. And if you put it on crypto, the performance is on completely different level, because thanks to algorithmic trading, you are taking advantage of portfolio trading, you are taking advantage of immature asset as crypto, and you are taking advantage of the third key, and its compounding effect. It is something that, again, traders often forget because they don't think over the long term. It's really about the long-term thinking. Once you think long-term and you can compound day by day, if the portfolio is growing, then on something like crypto, the results can be just tremendous. And yeah, that's it. That's all to the presentation. The only thing, for example, to see is the correlation table of the whole portfolio, which is just for your interest to see that the key again to get to stable results is pretty low correlation. Correlation is really the key, and you should concentrate on it as much as possible. And once your correlation is low, you just have to put these strategies together and work on the portfolios. Yeah. And last thing, maybe what we could think about is this return to drawdown ratio. It's not about showing off. It is more about showing that we are definitely in some stage when crypto is right now, and it will nothing but getting smaller. It's pretty sure. It's pretty obvious, because if something is giving potentially such a huge results, then the only thing, just remember this immature to mature cycle, the only thing that can happen, and we can see it thanks to our institutional clients, that it's pulling new capital into the market, and the new capital is pushing the liquidity, and it's basically pushing this inefficiencies lower. Yeah. So that's it.
Yeah, excellent. Yeah, first of all, this has been really fantastic so far. I think you were able to explain a ton of concepts really, really well. I definitely
Thank
want
you.
to dive a little bit deeper into a few of them. Um, First things first, looking back, you mentioned this very clearly, the kind of differences you can get from back tested strategies versus what you'll actually get going forward using it. Um, how much do you guys track at Robuxio the differences between like how your portfolios would perform going in the past versus how they're actually doing in the current day? What's kind of the difference in performances that you guys typically see?
That's great idea. Honestly, in crypto, it's slightly different compared to stocks, for example, because in stocks, you want to see the performance very similar to the backtest. In crypto, because you are getting through this immature to mature cycle, the strategies can deliver small results just by this cycle and just by crypto being a little bit more liquid and a little bit less inefficient. So
Mhm.
how we are approaching it is a little bit advanced thing, but maybe interesting for other traders, is that every single strategy that we trade has some benchmark that we created by ourselves. It
Mhm.
means that if I trade trend long strategy, I typically have another 2 to 4 strategies in the portfolio, not in the portfolio, but I have them built, and I create benchmark of them, and I can compare the strategy we are trading for our clients to this benchmark, and I can see if it is starting underperforming compared to the benchmark, or if it is in line with it, or if it is making even better results. But in general, what it is about is understand the strategy, because, for example, many traders do have some drawdown threshold, and if the strategy is getting below the drawdown, you just switch it off. Honestly, I think it's nonsense. It could be used if you really don't, or if you start with algorithmic trading, then you should have such a threshold. But
Mhm.
if you build your strategy with so-called idea first approach, which means that you know in which phases the strategy should deliver results, then, for example, you know that if, again, we are trading trend long strategy, and the market is in some prolonged period when there is no long trend, it is normal that the strategy can go through deeper drawdowns than in the back test, and it's perfectly normal. What will be problem if the strategy will start delivering deeper drawdowns in the growing market, for example?
Right.
So yeah, not sure if I answered your question, but it's more about understanding the solution, having the benchmark. Benchmark is super important. You should always have some kind of benchmark to compare it with. And yeah, and then it is about also metrics like expectancy and these really hard metrics. But these are not the most important ones. More important is to understand what the strategy is doing compared to the market.
No, I think that did answer my question, so thank you. And so this next question I really like to ask pretty much everybody who I get the chance to interview, and primarily discretionary traders or people who I've talked to. But I think it's a really interesting one, and I'm definitely interested in hear your guys' approach for this. The question is, how do you define and also manage risk in the markets?
Yeah, that's great question.
It's a
That's
tough
one of
question.
those. Yeah, that's one of those
Yeah.
questions that we could probably talk about
For
another
yeah.
2 hours.
Yeah.
But okay, so firstly, we have to define what's risk in general. What's risk in the asset that you are trading? For example, in crypto, there are some risks that are not anywhere else on any other asset, or at least they are minimized, like risk of having some allocation of on crypto exchange. That's one of the
Right.
biggest ones. On the other side, what I'm saying that once all the risks will be covered, the opportunity will be much lower. Okay, so let's define some risk. First is crypto exchange. Another one, that you are overexposed to one coin that will go to zero overnight without any liquidity. In
Right.
crypto, it could happen. Another one is just risk of huge movement during highly volatile environment, and you would be over leveraged, let's say. So once you have all these risks, let's say, specified, you can start covering them. Risk of crypto exchange, you can trade on many different solutions or many different exchanges and spread the risk a bit. Risk of too big allocation, well, trade portfolio of many strategies. And for example, what I didn't mention, that every strategy that I even showed you is trading between 10 to 20 positions. So at the end of the day, every single position has allocation between 1 to 3% maximum, so without leverage. So again, the risk is reduced quite a lot. And the risk of, let's say, being too overexposed in very sharp movement, let's say to the short side, these minus 30% days, they can happen in crypto. Those are, for example, in our solution covered again by portfolio approach, that way that we do trade breakout shorts again against our trend long strategies. So
Mhm.
we can get to drawdowns on trend long strategies, and we don't need to use stop losses, which is quite a big topic that not well depends on the asset and leverage that you trade. But the fact is that purely by stats, stop losses are making your performance worse. Usually, if you make such a test, that if you would use stop loss and you get out or on the stop loss, or you get out at the close of the bar if the stop loss is triggered, you always or almost always get better results without having this fixed stop. Why? Because of intraday mean reversion characteristics of the market. But of course, if you do trade with leverage, you always have to have your stop loss in the market. But I'm just saying that many traders are just reusing the same tools without proper research. So yeah,
I think that's an excellent answer to the question. So thank you.
thank you.
I think that's great. Um, the next question, it's also one I'm sure we could talk about for 4 hours, but maybe just from a high level, say my question is basically coming up with a new strategy. So maybe we could pick a trend long, for example. What would be the first steps when designing a new strategy, when coming up with an idea that you guys would take to, define the strategy as well as test
Yeah,
immediately if it's viable and something that should be pursued further?
that's another great question. Well, if I should give general recommendations, let's keep it like
High level, yeah.
a high level answer. I would recommend going with research first. Don't try to find something just by putting indicators in your backtesting platform and trying to find some positive results on the past data, because those strategies will highly probably lose over the long term. So let's start with some research or with books, some very old ideas from traders from 1980s, 1990s. Many of them still work pretty nicely. So do take advantage of it. We do have many strategies in the portfolio that have some roots in these old strategies.
Hmm.
Of course, you would need to make some tweaks. The tweaks are usually based on the asset you are trading. For example, let's reuse the idea of trend catcher. This is basically basic trend following strategy that is based on moving average 50. You just enter if the asset is above, close if it is below. It's working on many assets. Crypto is quicker. So by logic, it makes sense to go with a period slightly lower, to let's say moving average 20. And that's it. That's the idea, and the idea should be always based on some logical base, like trend and mean reversion,
Hmm.
momentum, breakout, mean reversion. These are the three ideas that you should always build your strategies on. Never try to build strategy based on your discretionary approach. This is probably the worst way how to build strategy. Is I was there too, that you are trading discretionary and you just put all the indicators or all the price action into some code. This is usually not working. You really should push it to very simple code. And then you have to start making many robustness checks. For us, what it means is that we are trading on the daily data. So we will build our own daily data based on offsets. It means that we are making our own 24 daily candles basically on every other hour. It's slightly advanced, but what you can do is that you can start making these robustness checks on 8 hours, 12 hours. Don't go to much lower time frames, because then the logics don't have to work just again by logic, because the lower you go with your trading approach or trading strategy, the more the market tends to mean revert. So
Mm.
maybe my biggest, and that's the last idea I would recommend, is start with research first and start with testing models without trying to find viable trading strategy, because through basic models, trend ones, mean reversion ones, you can really understand the market and what it is doing, and just then you can start building viable trading strategies, because without understanding the market, it's pretty high probability that you will fail over the long term.
Yeah, I think the simplicity equals robustness slide that you went through, that's a really key point.
Yeah,
That's a
that's
really key
super
point.
important.
Yeah.
Like, start with sound idea, momentum, breakout, mean reversion. Keep as little conditions as possible. Some of our strategies do have just two conditions. For example, the whole strategy is two conditions only, and it's performing, it's delivering profits. So as little conditions as possible, and then run robustness checks based on, robustness checks. We could go over robustness testing probably over many hours. So
No, that's great from a high level. And it's super cool to me how um, even combining two different strategies, a trend with a mean reversion or a trend short with a trend long, you can combine their individual metrics and it yields just completely different results, the combinedness. So that's super cool to me just as a concept. But first, that might be going off track a little bit. But first, one of the questions I had was, once you've got an individual strategy, what are some key metrics that you guys look at? And also, are there any data visualizations that help you analyze a strategy and see if it has merit, see if it should be explored further and to add to a bucket of trend strategies and then eventually to the overall portfolio construction?
yeah, great question. Another one. So for me, one of the most important metrics is expectancy or average trade. Why? Because the higher the expectancy, the higher basically the pillow, or the
Cushion.
more exactly potential profits you have before your strategy will start in, like, reducing profits because of slippage, because of fees, and so on. So definitely expectancy. For some, it is Sharpe ratio. For us, it is not that important because if you, for example, focus on Sharpe ratio, you would have to immediately exclude trend following strategies, but these are the most robust ones. So it really depends, because I do understand why Sharpe ratio is like industry standard, and many institutional clients want to trade high Sharpe portfolios because these deliver more stable results. And for many, it is important, but I wouldn't say that for retail trader, it is the most important ones. So expectancy, and then I would think that it is more about why you build your trading strategy. Because if you build your trading strategy for the purpose of being the part of the portfolio, it's slightly different than if you just build single strategy. Let's say that we have our trend catcher long, which is catching long trends basically. And let's think what's the other strategy that would give us profits in very different market conditions.
Right.
By logic, trend, something that is making money on short trends, right? So then you start seeking for strategies that are able to deliver profits in these conditions. And I don't care that much about single parameters if the expectancy is high enough. That's very important. Expectancy is very, very, very important for me. And once you have these two in the portfolio, then again, what's another strategy that is giving you the most benefits for the whole portfolio? So once you start building portfolios, the game is changing a bit, and you are not going over the single parameters. Of course, it has to have some basic parameters to be able to deliver profits over the long term, but then it is more about market phases when the strategy is able to help the whole portfolio.
Yeah, and just to kind of as a clarifying question and to make sure I'm understanding you, say you have a trend strategy that's acting well. Actually, we've got kind of examples on the screen here. The yellow one here during the period kind of in the middle, it's pretty much going flat, or declining. You would look to find a strategy that during that same period, those same kind of conditions, market regime, a strategy that complements that and is actually increasing during those periods. And then when the trend strategy is increasing, it's uncorrelated and not pulling back during that same period. Yeah.
Exactly. That's exactly the explanation. You are basically just trying to put together uncorrelated strategies. Uncorrelated. Basically, the correlation coefficient is something every trader, especially algorithmic one, should think about a lot and should understand very deeply and should start thinking about it, because thanks to uncorrelation, you can see that trend strategies are losing here, mean reversion strategies are making some money. Why? Because the whole market was going sideways. It was basically going up, down, up, down. In this environment, it's not possible to make money with trend strategies, but it is possible to make money with mean reversion strategies. It still means that you will have drawdowns, but those drawdowns, the length of the drawdowns are reduced by many X's compared to single strategy trading.
Yeah, excellent. And this is gonna be a tough question as well. So sorry in advance, but it's
No,
it's
no.
it's a, it's a fun topic to talk about. Um, it's kind of easy to wrap your head around when um, trading just using two strategies and allocating capital between them when the rule the code that switches one on, the other one is off. But when you're combining a mean reversion with a trend and all that, from a high level, how are you guys thinking about allocating capital to make sure that the combined performance is as best it can be? What do you guys do to think about that? How to allocate how much of your portfolio to one strategy versus another when they've got kind of vastly different rules that turn them on and off?
That's another great question. There are few key things that you have to think about if you put together the weights of single strategy in the portfolio. One is correlation again.
Yep.
It means if you have two strategies into the portfolio and those two strategies are a bit or even more correlated and you still want to keep them in the portfolio because of some reason, naturally you should push the weight of these two strategies lower because they will tend to deliver drawdowns in the same periods, and that's something you want to get rid of. So that's one thing. Another one is volatility. Generally speaking, the more volatile the strategy, the less the weight in the whole portfolio should be.
Mm-hmm.
And the third one is how your portfolio or when your portfolio should make profit or should make profits the most. For example, here you can see that even though mean reversion strategies are making new money, the whole portfolio is still in a drawdown. Why? Because we put slightly higher weight to trend strategies compared to mean reversion strategies because crypto is trending asset. Basically you want to extract profits from trends mainly, and you want to use mean reversion strategies as stabilizers of the whole portfolio. But for we have even clients who want to trade mean reversion only, or want to trade like only short-term breakout strategies and mean reversions to keep the stability higher. So then I would say that it is also about clients' needs or traders' needs. Let's keep it this way, and think about what do I trust more? What are the main characteristics of the asset I trade? And what's the volatility I want to get from my trading solution? So it's hard to give like very, very simple answer to it because it's really, really more advanced. But yeah, volatility, correlation, and the output of the portfolio is the key things that you should think about if you are playing with weights of the portfolio.
No, I think that's a good answer. And I also wanted to ask, just because this might be useful for some people watching, talking about your personal story. How did you first get into algorithmic trading? Did you start discretionary and then kind of make the switch?
Yeah.
And what was that kind of process, all like?
Yeah, as you said, I started as typical retail trader, so it was really through discretionary trading. I was trading on the start, like price action formations. I was losing money for some years. Then I made the switch to, I would call it semi-systematic approach, in the sense that I was measuring market movements of stock indexes.
Mhm.
Nasdaq 100 was the most tradable ones, and I was trading basically mean reversion strategies on 3 to 1 minute time frames if the market was overextended, and I was using level 2 data for it. So that was the first time I started being profitable. It was after quite a few years, and yeah, it was working. Next to it I was working on, I would call it systematic investing through these simple rotational strategies on stocks and on ETFs. And like 9 years ago, I started making the switch, and I finished the switch after my daughter was born, like 8+ years ago, because honestly, discretionary trading is super psychologically demanding, at least for me. But as I could see on many of my former trading colleagues, most of them made a switch to algorithmic trading too, because yeah, it's hard, even especially if you are like pushing the capital.
Yeah.
You probably even want to start trading other people money at some level, and then the game is on another level from the psychological point of view.
Yeah, and I'm kind of curious as well. What does a typical day look like for you in terms of what you're doing day to day? Because, the models are doing its thing. How much are you researching,
Yeah.
analyzing real time inputs? What was maybe kind of walk us through a typical day and what you're doing to, improve the overall portfolio?
Yeah, well, so right now the crypto trading, what we do at Robux, so it's fully automated. It's
Mm,
not on my stock portfolios. This is semi-automated in the terms that I do run my scanners. I do get these entries, exits, and just send it to interactive brokers one per day. So the trading part is really covered
right.
very, very simply thanks to our trading backend. But honestly, being completely honest, I wouldn't be able to build the trading backend by myself because it took the whole team 2 years and we are still building it. So I think, sorry, it's not completely to your question, but one of the advices or recommendations I would give is if you want to start with algorithmic trading, don't try to automate everything because the automation that should be the last step, and it's by far the most demanding ones because you have to understand strategies and then you really have to properly understand the code, and that's really not simple. So yeah, back to my trading day, it's more about research, it's about going through some research studies, going through Twitter too, because you get some good ideas there, and work on my trading models and just testing, reading. And then also what I do right now is having a lot of contacts with institutional investors and also retail clients because they are firstly our clients, of course, so I want to be in touch then, but
Yeah.
secondly, I try to understand what should be the ideal portfolio for them, because if you don't trade such a portfolio that you are able to stick to as a retail trader or as an institutional trader, doesn't matter at the end of the day, then you simply won't stick to it over the long term. And just over the long term, the statistics are playing out and we can make money. Over the short term, it's just pure luck. So yeah, it's about testing, reading, testing, and talking to clients. That's my whole day these days.
Yeah, perfect. And this next question is kind of coming back to the trading strategy a little bit. So sorry for jumping around. But say you've got a particular strategy or a group of trend strategies that are underperforming the benchmark based on what you guys have set. What are the steps you guys take to try to see what's going on and see what improvements you can make?
Yeah, so what's important to say is that we are trading from the daily data.
Yeah.
So if it is underperforming for a month, it doesn't mean anything basically. We are talking about quarters here of underperformance. So if I see such an underperformance, I start thinking about why,
Mm,
and if it is something that is still within the trading model or not. If it is not, yeah, I can just switch it. I can just start using different trading strategy. And if I think, or what I can do is that I will add similar strategy and I put the weight of the worst or the one that is underperforming, I put the weight slightly lower and put the other one next to the old one with again smaller weight, and I'm just looking at both of them. So I think that fixed thresholds are good for the start, but once you really start understanding the market and your strategies, it is more about managing them on the month to month basis or quarter to quarter basis. And you really have enough time to think about the whole solution. That's another reason why I want to trade from dailies, it's big, and it is that you have a lot of time
Mm-hmm.
to think, to make your research, to make some changes if it is necessary. But I'm not making changes very often these days, like one strategy a year. We are adding strategies to the portfolio as the research is continuing. We are always having some strategies in incubation and adding them to the portfolios if they are putting some uncorrelated benefit to the portfolio. That's something we always do, because the more strategies, the better. But I'm not switching off strategies that often.
Yeah, and for thinking of somebody watching this who maybe wants to dive deeper into this based on what they learned today, what resources would you kind of point them towards? What resources did you find helpful personally in learning more about how to do this, construct portfolios, test strategies? What would be maybe some books or other types of resources that you would point them towards?
Yeah, in general, I would start on Twitter. I would start finding or searching for algorithmic traders with some performance that are measurable.
Hmm.
Like Nick Rage would be good start that I would definitely recommend, or Lawrence Bernstorff could be good start too. So these are the guys I would start with, and then it is really more about going through research papers. Just start researching in Google momentum breakout model, mean reversion model, research paper, just that simply. And yeah, honestly, that's not the most exciting part of trading, but usually algorithmic trading is all about research, and the better you make your research, the higher the probability that you will make profits in the future. So you should love it, otherwise you won't stick to it.
Everybody just wanted the shortcut there that you were going to give them, and instead you said go read research papers. But that's where putting in the work makes a difference.
Yeah,
Um,
of course, it's a lot
yeah,
of work for sure.
yeah. Excellent. I've really enjoyed this. Thank you so much for your time. Just one last question. If you had to give advice to people watching this, it could be trading wise, could be life wise, systematic trading wise, discretionary wise, what would you kind of, say to everybody as kind of one last parting message?
Okay, avoid one mistake that is connected to trading, and it is, don't start trading, I mean with your money, real money, before you understand the markets. That's the key. You have to understand what the market is making on lower time frames, that it has like mean reversion characteristics. You have to understand what forex market is doing, what commodity markets are doing, what stocks are doing, what crypto is doing. And once you really understand the main probabilities through simple models, through research, doesn't matter, just then start thinking about trading. Don't skip this phase, because otherwise you just don't know what you are doing in the markets.
Yeah, excellent. Yeah, this has been really great. Thank you again for your time for putting this together. I think everybody watching it should have enjoyed it and gotten a lot of golden nuggets out of it. Even if you're not planning on, you know, setting up algorithmic trading, there's a lot of truths here that apply to designing one system, one strategy, one discretionary system. So, Pavel, thank you very much for your time. Please, everybody in the chat, say thank you to Pavel. And yeah, thanks so much. If you guys are enjoying this, go ahead and leave a like down below. Subscribe to the channel, and we'll be right back with our next presenter. Stay tuned. All right, welcome back, everybody. It's my pleasure to also be presenting at this year's TraderLion conference. And first of all, I want to thank everybody for tuning in. It's been a fantastic bunch of days. All of the speakers have been excellent, and hopefully you guys have taken a lot out of the experience. And if you did, please consider going ahead and leave a like down below in the video, subscribing to the channel. We've got a whole lot in store in the coming months and years that you don't want to miss out on. So make sure to subscribe, 100% free, and help us reach that 100,000 subscribers mark. With that said, today I'm really looking forward to be presenting on a topic that I think can help a lot of traders, especially aspiring ones who are just getting started. And there'll even be some great lessons, I'm sure, for the more experienced viewers today, because I'll kind of be sharing a lot of my key takeaways from my many interviews with market wizards, legendary traders, top performers in the USIC, really top traders that have mastered their own respective styles. But at the core, even though they trade differently, there's a lot of key principles, and that's what I'll be sharing with you guys today. So we'll be covering 10 different lessons, as well as many different examples of, setups that they trade similarly, how they interpret price action, many, really tangible takeaways that hopefully can help you accelerate your learning curve. So make sure to stick around until the end, and let's go ahead and dive right in. Before we get into the key lessons, just a little bit about myself for those of you who aren't familiar. I started trading in late 2018 while attending UMD and getting my bachelor's in mechanical engineering. I took a class taught by Dr. Eric Wish, who is himself an extremely successful trader who's been doing this for 50 years, but he actually trades part-time, meaning his full-time job is as a researcher and professor at UMD. And I took his class, Introduction to Technical Analysis, and then was a TA for the next few years, basically retaking the class because I loved it so much. Back in February of 2020, I started doing interviews with top traders. And these were really instrumental in speeding up my personal learning curve. It was a pleasure getting to meet, as well as, ask as many questions as I want to these top traders. What setups do they use? What's their position sizing? How do they manage risk? All these really important questions that you're trying to figure out at the beginning. I was able to do that. And I really think, I credit that to, helping me, lessen my drawdowns, find my setups faster, and just improving my performance, overall. So hopefully I can pass on those same lessons today. Over here on the right-hand side are a few examples of people who I've been fortunate enough to get to talk to and meet. Many of them are excellent traders. All of them are excellent traders. And it's really just been a pleasure to get to speak with them and, learn from them directly. So hopefully you guys, have found my interviews helpful if you've watched them previously. If not, hopefully you can get some key takeaways if you haven't watched all of them from today's presentation. Moving on, this slide I'm including because my main point is that all timeframes can be successful. I've interviewed traders who like to hold many months and years. Over here on the left-hand side, Kathy Donnelly, a fantastic trader who really has a long-term mindset, trades off weekly charts, looking to capture those full model book moves. And then all the way here on the right-hand side, we've got more intraday day traders, short-term momentum traders. And all along the spectrum, you can be extremely successful at this. There's just kind of important keys that you have to master, and you have to specialize in that particular style. That's going to be a key kind of reframe today. I'm going to say that a lot today. You got to specialize, focus on just a handful of setups, a select few stocks that meet very strict criteria, and then execute with strict risk management as well as discipline as well. But any time frame, whether you're a longer term position trader all the way up to a day trader, you can figure this out and achieve super performance. You just have to kind of focus and be very specific and really married to one style and really just get as good as you can be in that methodology. I want to start off with a little bit of analogy. Say you're an aspiring baseball player, you're a kid, you're 11, 13 years old. You want to be the best baseball player, the best hitter you can be. What can you do to improve your hitting? What are you going to actually go out and do? Well, you might go ahead and, buy tickets to your neighborhood game, watch your favorite player on that team. Maybe he's an all-star, maybe he's an MVP, and you might study his swing. You study how he approaches 2-1 counts. You study how he kind of bears down with 2 strikes, how he always takes the first pitch, and unless it's, it's going to be a strike round in the middle, how a strike right down the middle, how he always, waits for his pitch, ignores the junk thrown into the dirt, and is extremely patient and works the pitcher until he gets, his pitch that he's looking for at that at bat. You might study about, how maybe when they go in a slump, what do? They go to the batting cages, they refine their swing, they look at, game film. What are they doing wrong now that they were doing right earlier? What can they tweak to improve? What's the kind of iterative process to get back to where they want to be? You might study all of that. You might read The Science of Hitting by Ted Williams, and, learn all his key takeaways. But basically what you want to do is study success, and learn the key principles that you need to have to be a great hitter. Now that means maybe specializing in, batting average like Ichiro Suzuki, or, more home runs like Barry Bonds. Whatever technique you're looking to master, you're going to adjust your swing, your approach, all of that to suit that style, and then just become the best you can be at it. And you're going to study the greats who have done it before you. It's the exact same thing with training. You want to break down what makes these greats successful, the routines, the habits, the technique that they use, the hard work they put in the cage that goes unnoticed. You only see the games. You don't see all the hours and hours of studying game film, working in the cage, as I mentioned. And you want to take kind of mental and physical reps, hitting extremely mental. You want to visualize success. You want to go up there, knowing that you're going to get that base hit into the gap. And you're going to really work on your preparation, your mindset, so you're in the right frame of mind to approach that at bat, that situation, whatever it is. It could be the bottom of the ninth and, runners on second and third, 2 outs, and you have to get that hit. But you got to be prepared. If you're not prepared, you go up there, swinging at anything, you're not going to have a game plan. You're not going to be successful over the long term. And it's exactly the same as trading. All kind of performance endeavors, and athletics is very much a performance endeavor. Trading is as well. We're not really paid for, trying hard or, working at it. We're paid for results. And with that comes a lot of mental work, but you have to kind of put in the inputs to get to that point where you can be in the right frame of mind to be successful and achieve strong performance. So a big key there was when you're studying the greats, you basically want to reverse engineer what made them successful. Sure, there's going to be talent, when it comes to baseball, athletics, you can't, work hard enough and suddenly you're 6'8" and you're great at basketball. But it's everything outside of, luck that really decides whether you're going to be great at sports. Michael Jordan wasn't just the best because of his athletic abilities. It was his mentality, his work ethic, how hard he worked at getting better every single day. Kobe Bryant, exactly the same thing. So you want to reverse engineer what they did to be the best version of themselves. Maybe an athlete, wasn't going to be an all-star MVP, but they can still become, an NBA player, which by itself is extremely, a select few people ever get to become that. And that's because they've worked hard, they've gritted through it, they've worked hard on becoming a smarter basketball player, not just relying on athletic abilities. All of that comes to play, and you want to reverse engineer the success of, great athletes if you want to be one. And then for traders, reverse engineer what made them successful. What's great about, the current environment and the current times when learning trading specifically is that the pieces are out there often for free. We've got this conference here. We've got all the resources on TraderLion, other channels, other books, which are, extremely low cost from the reward you can get from them. The pieces are out there, and it's up to you to take the initiative and go out and do it. You have to focus inward, compete with yourself from one day, 1 month, 1 year ago. You don't want to be comparing to yourself to somebody who's already been trading for 10 years and, is doing extremely well on social media. You want to focus on yourself, because how they're doing has no impact on your accounts and whether you're growing them or not. So focus on yourself. You can learn from them, but you have to really, take the initiative yourself, put in the work yourself so you can get to that point. Then, and we'll get into this later, you have to conduct post-analysis, study your own performance. What are you doing right? What are you doing wrong? Study your trades. What are your top winners over the past 50 trades? What do they have in common? Maybe go ahead and focus more on that setup. What were your worst trades? What could you just kind of eliminate and it would improve your performance? That's extremely important, especially early on. When I first did post-analysis for the very first time in 2019, I noticed that, I was picking really strong stocks. They were good stocks, but I was getting stopped out and then it would take off without me. And I didn't know why this was happening, but I went back and studied the trades, marked up where I bought and where I sold. And I was buying basically always, 3 to 4 days late from a tight consolidation, a tight area. I was buying when it was already kind of extended from the proper buy point. And, just kind of as an observer, having traded those names, I would never have realized that, made that realization if I actually hadn't gone back and done the work, marked up my entries, my exits, all of that, and studied what I was doing wrong. And once I eliminated that, I realized I had to find a better setup, a better entry tactic, buy earlier at the proper time. And that way I was able to manage risk tightly, but also get aboard the stocks that moved well, because when I was buying extended, they would just kind of shake me out with normal price action and then just take off. And I was left kind of bewildered, what happened. But if I didn't go back and do post analysis, I wouldn't have been able to come to that realization. And then this last point here is extremely important. Nothing matters unless you commit to learning, regardless of strategy. So, everybody watching this right now, you are committed to learning. You want to improve as a trader. Point in fact, because you're here watching this right now. So you want to improve, which is the first step and really the hardest step. So now what you have to do is just keep that up for the next few months, years. You're going to always be improving. You see photos of Darvis, like this picture where he's doing his post-analysis work, looking at charts. The legends, the top traders never stop studying and trying to improve. There's always something that you can improve on when it comes to trading, when it comes to life, but especially in trading, there's always something that you can work on: your entries, your exits, your risk management, what have you. There's always an area that you can identify as your current weakness that if you just improve that a little bit would really turn the needle and improve your performance. So that's one of the most important keys of reverse engineering success is come here with a mindset that you're here to learn and you're here to improve. And by the way, that's kind of one of the things that hurts people when it comes to post-analysis. They don't want to be vulnerable to the truth of their performance. They're coming in with a mindset that, I don't want to make mistakes. I don't want to see my mistakes, but really, recognizing those and actually looking at them makes you a stronger trader. So don't be afraid to be vulnerable to the truth about your trading. In fact, that's the only true way to go ahead and improve. So make sure you guys go ahead and do that. All right, so let's get into the lessons now. First, I've already talked to this a little bit, but trading takes patience and hard work. Again, we've got a legend, William O'Neill, who's inspired so many traders. I'm sure many of you watching here can credit, a lot of your first interest and knowledge about the markets and how they truly work from William O'Neill. Almost every market wizard and top trader I've interviewed over the past few years, credits William O'Neill for part of their system. Maybe not the whole thing. Maybe they've adapted it, but he's provided the framework, Can Slim, which has been successful for decades and decades and decades, and has helped, teach so many traders. So we're all extremely thankful to him. But something that people who knew him and worked with him, Ross, Mike Webster, they always say how hard he worked, how much time he put into this, and how strict he was about putting in that work. So every one of the traders I've interviewed, they struggled for years before finding their footing, but they kept at it. They persevered. They worked through it. They put in the long hours. They went and did a deep dive into a setup, into analyzing the greatest winning stocks of the past 10 years. To achieve better results, they studied the best traders, the best stocks, and then kind of took that knowledge, took their key takeaways, and focused on one specific style and time frame. They made whatever system they were studying, whether they were studying Darvis's style with boxes, William O'Neill's with Can Slim. They made it their own. They altered it to suit their personality. their personal style. Maybe you like to trade cancel stocks, but you're trading more as a swing trader. The first, few days after a breakout, that's your bread and butter. And then you just kind of, find the next setup and sell to strength and aren't really trying to hold for the big move like O'Neill did, but you're still using that same base framework. Many of them read and were inspired by similar books and traders: Darvis, O'Neill, Livermore, Douglas, Minervini. What's great about trading is, you don't really have to reinvent the wheel. You just have to kind of study what the great traders have already done, learn the principles behind their system, and all of those are shared. And a lot of that is what I'm, teaching today in this presentation. So again, you have to put in the work. Here are some recommended books. I always get asked this. So How to Make Money in Stocks, one of the first books I read, excellent, very thorough. In fact, I'm due for a reread. It's right over my shoulder over here. Third tries the charm. It's an excellent book. It's foundational, and it's just, I highly recommend it. If you're going to read one of these books, go ahead and do that one. How I Made $2 Million in the Stock Market. This is maybe my favorite. It was the first book that I got to read. It follows Darvis and when he was, just learning to trade and developing a system. So it's kind of perfect for to read along, because you get to see what mistakes he was making, and they're the mistakes that every single trader makes as they're learning. He was buying extended. He was focusing too much on fundamentals. He wasn't, watching price action. He, was oversizing. He got too, he experienced too much noise, and that affected him. Every single, obstacle that he meets in that book, you're going to meet at some point along your journey. So go ahead and read that. And that way you've got a warning and you know what to look out for. How to Trade in Stocks by Jesse Livermore, excellent. Reminiscences of a Stock Market Operator, also about Jesse Livermore, is excellent. Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. Of course, you guys got to see him last weekend, which is amazing, but highly recommend that book as well. Watch videos, webinars, write trading rules. I want to emphasize this because in the chat right now, I want you guys to be honest. Do you have a full set of trading rules that defines your system? And is it updated? Maybe you've got something, but it's been a few years and you've kind of changed some things. So let me know in the chat, yes or no, do you have an updated set of trading rules? If the answer is no, one of your tasks today that I'm assigning you didn't know I was assigning homework, but one of my, your assignments is to go out, take 2 days, define your system. What are you looking for in terms of stock selection, market analysis, your setups, your risk management? Define everything that you need to for a similar trader with your same knowledge to follow that system, and he would be trading how you trade. It doesn't take too long in the respect of you're going to be doing this for decades and you want to have, great performance. So you got to invest the time and put in the work and actually go ahead and do that. If you're watching this conference, you're doing kind of the learning part, but then you have to go out and apply it. That's the next step. And without the application of the knowledge that you've gained from this conference, it's not worth your time. Pay it forward. Your future self will thank you because of the great returns that you've got. Define your system and update it if you still need to, even if you've got, an old set of rules that you're currently using. Lesson 2, stay positive, stay focused, stay disciplined. As I mentioned, many traders struggled for years before they became successful. We did a masterclass with John Boyk, and many of the top traders that we analyzed in that masterclass, whether it's Livermore, Wyckoff, O'Neill, many of them took years and years, often I think on average around 6 years, to find their footing, develop their system. And that kind of lines up with, 1 or 2 bear and bull market cycles. And I think that's kind of what it takes to get the seat time, the experience to, put all the pieces together, because maybe you can learn a setup, but the market won't be right and you're using it at the wrong time. So it takes some time and some real experience to actually apply everything. I'm still, applying stuff that I'm learning and developing, my style. I'm always improving for sure. It just kind of takes that time to figure things out and actually grow confident in your trading. But overall, it really pays to stay positive, to persevere. It pays to be a bull over the long term. Again, 6 years is a very small investment to be able to do this for decades and decades at a very high level. You want to treat setbacks as learning moments, especially in your first few years. And even though it took the legend 6 years, I think nowadays with the information that we have available, this conference, the interviews that I've done, it shouldn't have to take 6 years. You should learn from others, learn how to manage risk tightly, learn their setups. Of course, you want to adapt everything and kind of master it for yourself. But the learning curve today, I think, has the potential to be that much shorter than what people had to deal with decades ago, when there wasn't the internet, there wasn't YouTube, there weren't the books and resources that there are today. So you should strive to work hard and just get through it as quickly as possible. And again, treat setbacks as learning moments. There's going to be bear markets where you're going to lose a little bit too much, draw down too much. It's just a learning moment, and over time you'll improve. It should be all focused on incremental improvement. Just be a little bit better than you were yesterday, a week ago, a month ago, last market cycle. Just try to improve a little bit over time, and that will really add up over the long term and compound as well. Also, I say here, stick to one strategy and become a master at that particular method and setup. As I mentioned earlier, when we were looking at the time frames, each of those traders really has a focus on, whether it's day trading, swing trading, momentum bursts, longer term position trading, longer term investing, really trading the long term 18 month model book stock moves. Whatever their style is, they stick to that and really focus on that. Maybe they have adapted a little bit depending on market conditions, but overall they're staying true to one style and just becoming the best that they can at that. And that involves eliminating the other styles and not focusing on them. Maybe you're a position trader, but there's this, amazing day trade opportunity where the stock has this amazing catalyst. It's up, 200% in pre-market, huge volume. They're going to cure cancer, all cancers. Everybody's caught off guard. And it just has amazing potential. For a day trader, that is the bread and butter. They should go focus on those. But as a position trader, you're not going to be as good at position trading if you're also focused over here and all these opportunities outside of your system. Eliminate the noise, because you might, if you're looking at that, you might not trade it as well because you're not used to the setups, the routines, all of that to be successful at that. You're not kind of programmed to be good at that. But also, if you're focused on other things, you're not going to be the best position trader. You're going to miss those opportunities, and that's what you should be focused on so you can execute your style and system. Again, you've got to commit to learning. We mentioned this. If you're here today, you're committing to learning, which is awesome. And then you want to judge your trading based on whether you executed your plan, not whether you made money or lost money on a trade. And I think this is the key mindset shift that you can make while doing post-analysis and getting yourself to do post-analysis is every trade that you make, whether it was a winner or a loser, has the potential to help you make better trades in the future. So your biggest loser might actually pay you way more than your biggest winner in the long term, because you might realize a mistake that you're making, or a lapse in your routine, or a lapse in your system that just allows you to blow your overall performance out of the water because you fixed that step. So think about that when you're, not feeling good about a trade that you made. You don't want to go ahead and look back at it, chart it out. Just think about the potential money that you could make by putting in the work and doing post-analysis. And here, of course, I've got Jim Ropel on this slide because if you've ever listened to interviews that he's done, it's extremely hard to not be positive, focused, and just fired up to trade and improve. If you've watched, his confidence is amazing. And, he's kind of said this multiple times in different interviews. Every year there are model book stock opportunities, and every bull market, there's going to be stocks that 5X, 10X. And, we just have to stick around and try to get one of those, try to get two of those. And every single year there are more at bats where you can hit it out of the park. So if you have that mindset and think about how long you'll be trading and how many opportunities you'll have to catch the next Tesla, the next Amazon, the next Netflix, that could be even better than those stocks and perform even better, that should get you extremely excited about putting in the work now, so you're prepared when those situations come. And I highly recommend checking out interviews with Jim. He's fantastic, absolutely fantastic, and I've learned a ton from him. Here's some more things about staying positive, staying focused, staying disciplined. Take some time each day to reflect. I've made a very quick kind of Google, what's it called? Google prompt or poll or whatever. I've set it up, to analyze my day. How did I think I performed? What did the market do to that day? What trades did I make? What do I think I could have done better? What's my current portfolio? I've got all that set up, so it's automatically, I just fill out the form. It takes 5 minutes, and then I've got that data to go back and analyze. And that reflection, not only helps me if I want to look back and improve something, have that data so I can analyze it, but it also kind of helps me, de-stress from the day. I can leave everything in the form, how I'm feeling, whether I traded well, traded poorly, and just get it out on the paper, and that helps kind of allows me to move on and get on to, the fun stuff I want to do, whether that's hanging out with friends, playing soccer, whatever, and kind of leave it all, at the trading desk. So make sure you are following your weekend and daily routines. Again, this is critical for making sure you're ready to execute at your best. Again, to use the analogy of it's the ninth inning, runner on second and third, 2 outs. If you're not mentally ready to execute and hit at that instance, you haven't studied the pitcher, you haven't done your warm-ups, you're cold, you're putting yourself at a disadvantage right away. It's the same with trading. If you don't do your routines, whether it's the night before, the day of, if you don't sleep well, if you don't eat well, if you're not in good health, you're putting yourself at a disadvantage, and that's going to lower your performance over the long term. And again, here I also mentioned avoid the noise as much as possible. Twitter, even other traders. Again, you can definitely learn from them. You can study them. There's many people I've learned an immense amount from who are on Twitter. But during the trading day, when it's time to execute, you have to make sure that you're very selective with the information that you use as inputs. And often Twitter is not helpful at all. So keep that in mind. Make it an exercise, a challenge for yourself over the next 3 months to shut off Twitter, close it out. Don't even look at it until 12 p.m. or after the market's closed, even better. And see how your performance changes after you kind of reliant on yourself. You're not relying on anybody else to be posting a stock and then, oh, that looks good, I'll buy it now. Focus on yourself, focus on your own personal game plan. And that will allow you to perform extremely, extremely well. So say no to FOMO, do those routines. That's extremely important for setting yourself up for success. Lesson 3, stay in tune with your own trading. And I kind of mentioned this already with post-analysis and keeping a journal. It allows you to keep a mental picture of how recent trades have performed, which is extremely important feedback. All of the top traders who I've interviewed use recent trades as feedback for how much they're going to be sizing, how aggressive they're going to be, what's their views on market conditions. And on the downside as well as the upside, if they start putting on trades and they're working really well, it's the start of a turn, they're going to really double down and be aggressive right at that instant. And that allows them to perform during that uptrend. So it happens both ways. You got to do it both ways, both to the downside, when we've been in a trend and things start, not working so well. And on the flip side, and this is something I'm personally working on, getting aggressive early in the trend as your pilot buys are working. That's what the best traders do. And that's kind of one of the keys to success, is being very in tune with the market cycle as defined by the success of your own trading, analyzing market indexes, leadership, but your own trading is the most important indicator that you have. Because, if you're not trading well, by definition, the market isn't right. Or it's not performing, or you're not right for that market, and you should take a step back. But if you're trading well, you should step on the gas and try to get the most out of that period where you're on top of your game and doing extremely well. So take market feedback into account, practice progressive exposure, trade your largest at your best. This is a paraphrase from Mark Minervini, and the smallest when you're trading your worst. Did you have multiple failed breakouts, stop trades in a row, maybe scale back and reevaluate? Or pilot trades working after correction, increase exposure, be more aggressive. And remember, you are never forced to trade. That's one of the most amazing things about trading. It's like you're at the poker table and you can see everybody else's hands as well as your own hand, and you can decide whether you want to play that hand. If you don't, you just wait until you get a better hand and everybody else has a better hand. You're never forced to trade. Trade when the situation and environment, everything's lining up and it's ideal for you. and take a step back when the deck is cold, and don't force anything just because you need to trade, because nobody needs to trade. Trade when the probabilities are lining up for you, and that's lining up the market, that's lining up groups, that's lining up the individual stocks, that's lining up yourself. Are you ready to trade? Everything needs to come together, and that's the ideal situation. So here I've got a quick graphic, action and effect. Unless you have that feedback loop, you're never gonna really reach that higher echelon of trading and get to your best, because if without feedback you can't improve. I'm an engineer by trade. Every single system that is pretty much designed has feedback loops to make sure it stays on track, doesn't overheat, is producing optimal energy. Whatever system it is, whatever type of system it is, there's feedback loops designed to keep it on track and to get the most out of most efficiency outside of the system. Lesson 4, focus only on high potential stocks. And I alluded to this earlier, but each style is going to have their own definition for high potential stocks. For day traders, it's stocks in play. It's stocks moving on news catalysts that can trend 30, 100% plus in a day. For short-term swing momentum traders, it's very tight stocks that can move really nicely for a few days. Maybe it's the start of a bigger move, but you don't care. You're just looking for that short-term momentum burst, and you're looking for that. It's earnings gaps. For position traders, it's more stocks that have maybe the technical characteristics, but also they have amazing growth drivers like earnings, sales. Depending on your style, the characteristics you look for, both technically and fundamentally, will change. And the longer term you are, the more it's geared towards the fundamentals. The shorter term you are, the more it's geared towards the technicals. And you have to kind of find that balance for yourself. But whatever it is, focus on the most superior opportunities that match the exact template that you're looking for. And often, for all styles, there's some key principles that is shared. Either superior price action or true market leader quality. Ideally, both come together. Significant signs of accumulation. That means big moves up on volume, gap ups, burst through moving averages, breaking through resistance, all of that. Ideally, and we'll get into some of the setups that these traders use in just a second, but ideally it's an early stage base breakout. Could be the IPO base, could be the first constructive consolidation after a strong uptrend, or the first base after a longer term correction, where everything's coming together and we're starting a new stage 2 uptrend. A lot of the top traders I interviewed look for leading stocks and leading groups. So they've got the group and sector working for them. There's a theme associated with it, breakout sales growth, earnings growth. Again, it just kind of has to match the template of the stock that you're looking for. That's the best type of opportunity for your time frame. Day traders, stocks in play, huge gap ups. Maybe, position traders might play that, but not as volatile stocks. Some stocks will pop for one day, and day traders will, make a killing, and that's the end of the trade. They're not going to look at that stock because it fails the next day. Whereas position traders might be looking more for long-term time moves where it can last many weeks and months, and move really strongly, but it takes time to get there. But they can size higher, they can have more conviction because there's a fundamental driver behind the stock. So again, whatever your style is, find the template and create the template for yourself in your own mind, and define it in your trading rules of what the best opportunity looks like for your style. That's the key. And go back and study historical examples to get there, and build a playbook, as we'll get into, for those high potential stocks. Overall, again, a common thing that the top traders I interview look for is that the long-term trend of the price action should be increasing. So here we've got NVIDIA over here. This is the start of the stage 2 uptrend. There's a weekly chart here. We've got a break above the 50-day moving average, the breakout from this base, and we've got this longer-term uptrend. Within this move, day traders might be focused on, the days in here, whereas position traders like to focus on the longer term move. Swing traders might be, just selling into strength right here. Whatever your style is, true market leaders can work for you. And they're often the most kind of aggravation free, as Ross Haber says, type of trades. They're liquid. They're being supported at logical spots. Their character is a little bit more learnable. That's not quite a word, but you know what I'm saying. You can gather how they trade and kind of expect things and nothing's going to catch you off guard until the trend changes. And that in of itself is a signal that you should take into your trading. But a lot of the traders I look for, they're looking for longer term uptrends and then spots to enter to play the continuation moves within that longer term uptrend. Here's the Deep View Leaders preset screen, which is available in the platform to everybody. This is the criteria right here. We've got the AND group where all these criteria need to be met, and then these kind of look for different things, whether it's really strong relative strength, really strong earnings or sales growth, or really strong relative strength, or decent sales over the past year, or it's in a longer term uptrend, or it's a recent IPO, or it just is extremely, extremely strong. This is kind of my go-to screen. If there's only one screen I would use, it would be the Deep View Leaders screen. And this is kind of, again, just kind of my first group of stocks to fish in. This usually comes up with around 200 names that are in top groups that have the top RS, that then I look for the setups that I look for. And that's how I like to find my trades. But just over here, talking about the mandatory criteria, it has to have a minimum of 20 million liquidity. That makes sure that it's at least somewhat institutional quality, because those stocks, when the institutions are able to trade them, are going to make the biggest moves, or not the biggest moves, but the most sustained, aggravation-free moves. There's going to be names with, less than $1 million volume that can pop amazingly, but it's going to be extremely volatile, and it's just a liquid, harder to trade. ADR, I want to make sure that a stock that I'm trading can actually move. This can honestly be a little bit higher, but I don't want to eliminate too much. 2%, 2.5%. I know Kwalmagi has what he looks for. If in the chat, you can put that down. I think it's 2.5 or 3%. ADRs are common stocks over $12.5, market cap of 1 billion. And looking at this mandatory criteria, again, it's going to eliminate some stocks that might 10x, 100x, but it's kind of trying to find and eliminate all the stocks that don't match the template that position and swing traders are looking for. And this will come up with, 99% of the top leaders for each market cycle. At least that, that's been our experience so far. So this is just a recommended screen. If you've got Deep View, you can run this right in presets. If you don't have Deep View, you should check out our special offer. We're building the best platform for swing and position traders, period. We've got a special offer. Like I said, the link should be down below in the description. Moving on to lesson 4, and this is still on focus on high potential stocks. This is just a few things to screen for. If you don't want to use that preset, screen for longer term uptrends, big gap ups on big volume, top 1 month relative strength, top 3 month relative strength, high ADR percentage, group moves, news catalysts, earnings, gappers, themes, crypto, semis, AI, EV, whatever market cycle you're in, there's going to be a key theme or a few themes that are kind of driving the best moves. So if you learn to recognize what those stories look like, you'll be on top of those stocks, before, early on in their trend. So that's a really big key thing that you want to look for. And that's what the top traders do. They analyze, what are the themes that are most active right now? What's the fundamental driver behind them? All right, I'm going to focus on crypto stocks because, Bitcoin's driving everything. All right, AI is going to disrupt everything. I'm going to focus on semis and AI related stocks, and they have the greatest potential now. Keep a running list of these leadership quality stocks, and then you can always look to find your setups, the top 1% of the 1% high potential stocks, and that's how you can find the best of the best leaders. I often see the question, I get asked this, how do these top traders always seem to be in the SMCIs, the NVIDIAs of the day? It's because they're really focused on RS. They're focused on the themes that, are leading the market. And then they're focused on the price action and can work themselves in to those leaders as they're starting or reconfirming moves and building new uptrends. So that's, my answer for that. Lesson 5, use charts to identify setups and time trades. Almost every single person, every single top trader, market wizard who I've interviewed analyzes charts in some way. We've got Jason Shapiro, who has his COT edge, and that's a version of charts for sure. But most of them kind of look at price and volume charts, and they analyze them very carefully. They know what their entry tactics look like, their setups look like, the edges that get them onto a stock look like. They basically are looking for standout relative strength, and institutional footprints. Again, signs of accumulation, big volume up weeks, gap ups on volume, strong prior uptrends, all of that. And the best traders I found not only, leverage money, but they also leverage time, meaning they're entering a stock when it's perfectly set up to make a big move quickly for their system. And you want to enter at a point where a large directional move is expected, and you can know exactly the point where the setup fails, so you know where to manage your risk and get out. The goal is to be in a profit almost immediately or stopped out quickly, and you can either move on to another opportunity, step back, reevaluate, enter it again the next day if it sets up again. But the key is to master a repeatable setup that kind of fits this criteria right here, because that's the key to be able to manage risk, to be able to size up larger, so you move the needle when stocks work in your favor, and if it doesn't, you're just out with paper cuts. That's kind of the most important key. Ross Haber has a saying: you want to keep your stops tight and logical. In order for you to do that, where it's a small loss if you get it wrong, and it's also at a logical spot that tells you if the setup is wrong, you need to follow this, and that is what allows you to size up big and really move the needle when an SMC, when you catch an SMCI or an NVIDIA that can make a 30, 40, 100% move in just a short amount of time. As Sage Analysis says and Stan Weinstein says, chart reading can help traders and investors of any time frame. I think even if you're long-term investors, you'll benefit from entering at the beginning of stage 2. I put out a tweet a few days ago, I think, analyzing kind of the NVIDIA move up to this point. And actually, I'll go to, here it is. So, this area here, this is the zone for both investors and traders to be looking to enter. And if you're an investor, maybe you're dollar cost averaging during this time, the start of the stage 2 uptrend, or even a little bit before as we get above the 50-day, 10-week moving average. So charts can help your timing, and that, again, leverages your time and money. So you're keeping your losses smaller and your profits, as large as possible as the trend is just getting underway. That's kind of our goal here. Why use charts? Again, you can analyze supply and demand. You can look for those institutional footprints, identify the high potential stocks. You can clearly define both stop loss area and profit taking area. You've got defined risk reward. You can define rules to organize your trading, and you can analyze the trend on multiple time frames. Are you trading with the wind at your back? And this, I think, is a great quote from Tom Basso. The closer you can get your indicators to that which is creating the profits and creating the risk, the more you can control things and run a tighter ship. And, price action is about as close as you can get. Lesson 5. So again, using charts to identify setups and time trades. I'll be going through a few of kind of common setups that these top traders and market wizards use. We've got earnings gap ups, IPO-based breakouts, early stage-based breakouts, as well as VCP type bases. So first up, earnings gaps. This is SMCI, which reported earnings right back here. We had a nice gap up, which triggered this breakout. You could enter on this day. You could enter at the tight area after this. There's many ways to play this, but this type of setup is very common. You've seen it from Pradeep, you've seen it from Kalamagi, earnings gaps. Many cancel traders are now kind of adopting this, and it's just a news catalyst that is causing the street to get caught off guard, and the need for them to for large institutions to reevaluate their position sizing, allocate more capital to the stock, which creates this big demand, which not only lasts that first day, but they keep coming back to it because they can't buy just in one day. They have to keep buying on any weakness, and that creates the trends above the moving averages that we can ride as retail traders. So this is an example with SMCI. We've also got ARM earlier this year, where we had a large gap up, huge momentum move the first day, inside day. You could have bought the HVC here, though also try to find a spot intraday here, and then another huge move here. So this kind of shows you the potential for these earning gap type moves, basically very strong performance in just a short amount of time. And for position traders, this can lead to longer term durations, trends that can last, months and even years. I think I don't show ELF, but ELF is a great example for many, many earnings gaps along the cycle, during that longer term trend. And it can all start there, or you can add there. or it's just a sign that, institutions are still being surprised and, adjusting their positions. So the earnings gap is a great setup to master. We had Pradeep present the first day. That's a great resource if you would like to learn more about, earnings gap ups, as well as just kind of stocks in play and EPs. Next up, we've got the IPO based breakout. This is an example from earlier this year, Shark Ninja. This has doubled since this breakout here. And the IPO based breakout, for me personally, and the top traders who I've talked to, they're often not waiting for the breakout through the highs. They're looking for tighter entries up the right hand side. After the stock has kind of shown support, it's built a little bit of a base. They're looking for tight areas, alternate pivots earlier on in the base. We've got one here, this line of resistance, RMV, which is relative measured volatility, goes to 0 in this area, showing it's tightening up. You then can look for that pivot and buy that breakout. You've also got this pivot that forms. You've got a gap and go that is triggered from that tight area. This could have been your entry here. And then you've got a position before that base breakout where often there's volatility. Here, there wasn't really much, but it just allows you to get on that trend a little bit earlier and often manage risk a little bit tighter as well. And this has been a top performer, but the IPO base in general is a fantastic setup. And you can see the effectiveness. We've got PLTR a few years ago. Again, we've got these tight areas shown by RMV. This basically helps you identify VCP characteristics, tight areas that you can manage risk and are showing accumulation. I've got a whole webinar on RMV if you're curious. And the great thing about DeepView is you can scan by it. So you can scan for stocks showing VCPs and tight areas, along with any other condition you want, relative strength, trends above moving average, all of that. So check out DeepView if you haven't already. PLTR, great example, breakout from this tight area earlier than the base, the IPO base pivot, breakout, volumes picking up, and just a beautiful move from the IPO. This was stellar. I think Corsair was also making a similar move, another IPO during this exact same time. Those two IPO moves just kind of are ingrained in my mind. Then we've got ARM from this year. Again, we've got more of a longer term base. This could have been an entry point if we broke out here, but we break lower. We're still basing. Then we start to form higher lows here. This is your first higher low after this one. And then we get a second higher low. And what happens? RMV goes to 0, showing this tight area. This would show up on your screens right in this area. You can buy this subtle breakout, reclaiming the moving averages and moving above the highs right here. And then it even forms one other tight area as shown by RMV getting close to 0. And you've got a line of resistance going across. This has been an ideal entry. Strong breakout inside day, reconfirmation. And, ARM has done extremely well this year. It's probably one of the best opportunities of last year in this one. And IPO-based breakouts in general can have these great moves here when the conditions are right. This isn't going to work really in bear markets. But when things are rocking and rolling, these can be great opportunities, as you can see from the ARM chart if you bring it up on your own. Early stage base breakout here. Again, we've got NVIDIA just started its longer term uptrend. We've got the base here. We've got this mini base on top of it, and you could have bought this breakout and just kind of ridden everything that's happened after that. So these early breakouts often have great risk reward because the street is still, institutions are still accumulating. Later on in the move, things get choppier because, some are selling, some are buying. But these early stage base breakouts, if you can identify the theme, the earnings growth, everything coming together, if you can identify them early and buy these early stage base breakouts, they can be tremendous opportunities. And many of the top traders like to find, up the right-hand side entries through tight areas to get in before, that key base pivot. That's a very common thing. Next up, we've got VCP, which is volatility contraction pattern, coined by Mark Minervini. Wyckoff looked for springs. Everybody looks for tight price action. That's a key thing that's shared among the top traders that I look for. And here we've got IBIT very tight in here, RMV going to 0. Again, back here, RMV going to 0. And you get explosive moves from these contractions. Stocks move in between during trends from expansions, contractions, expansions, contractions. And when they're really tight like here, you can manage your risk right at lows, and you'll likely get a stronger move up, which gets you in a profit if it works right away. And that's kind of the key benefit of VCP. Here we've got coin showing a more advanced version of this. Again, we've got a base that forms. We start to form higher lows. This is a higher low. We get a tight range shown by RMV. And then you could have bought the gap up or the range after that or the range after that. RMV again going to close to zero. Tighter entries up the right hand side. This is a key. If you can take away one thing from my presentation today, look for when a stock moves up the right hand side, reclaims the 21 EMA, look for tight areas against moving averages, the 10 EMA, the 21 EMA. That's Oliver Kell's EMA crossback. Those are often great, low risk, high reward potential entries because you're getting in before the base breakout. You've got a cushion as we approach that key level in the markets, and you can manage your risk very tightly against those moving averages as well as the lows of the range. So that's why VCPs are so popular. Lesson 6. And, this honestly should have been lesson number 1, especially if you're just starting out. You have to manage risk tightly and use stop losses. Not every market wizard who I've talked to uses stop losses specifically, but they all manage risk very tightly in some way or another. And some of them risk more, some of them risk less, but as a percentage of their account, but they're always making sure this is priority number 1 is managing their risk, keeping their losses small. And if you cannot manage risk, don't take the trade. If you cannot manage risk, don't take the trade. If you cannot manage risk, don't take the trade. If you can't place a tight and logical stop loss, you're not executing a proper setup. Remember that. Per position, the best traders I've interviewed keep stop losses on their positions, on their individual position. This is in a portfolio under 5%. Usually they're 3 to 4%, 5%. That gives for short-term momentum traders, swing traders, position traders, you can usually find entries, as I mentioned, from tight areas that allows you to do this. And keeping it this tight allows them to do extremely well in terms of risk multiples when they do get a winner. And you want to basically cut losses at a fraction of your average gain, 3 to 1, 2 to 1. That's excellent. It builds in failure. We've got a table over here. I'm sure you guys have seen this, but it's the percentage loss required and percentage gain just to break even after you experience it. So as you go down here, you can see the tremendous more amount of work you have to do to get to break even. And this goes into lessening your drawdowns as well as keeping your stops as tight as you can on individual positions, because both ways to look at risk on a portfolio level as well as individual stock level is so important. And this is probably the biggest edge we have as retail traders is we can control very tightly how much we're risking, what our position sizing is, where do we exit if the trade doesn't work. And because of that, we could take advantage of the amazing trends that occur in the markets that are driven by institutions. We can jump on for the ride while risking extremely little in comparison. So this slide and this skill is probably the most important thing. And especially if you're newer, don't disregard this because it's not the sexy part of trading. It's not the setups. It's not entry tactics, but managing risk tightly and keeping those losses small keeps you in the game and make sure you're around for future bull markets and around to catch future market leaders. So it's incredibly important. Lesson 7, establish routines and practice discipline. Every single one of the traders who I've interviewed has a defined routine, whether it's daily or weekly, that puts them, as I mentioned, in the best state possible to execute their strategy successfully. Whether that's analyzing the markets, analyzing opportunities, running screens, doing yoga, reading the Bible, everything they do sets themselves up for success later on. So in terms of just some suggestions, weekly routine, you can analyze the market, analyze your trades from that past week. Again, use that feedback to decide how aggressive you're going to be. On the weekly routine, you can build your focus list, the best of the best setups for high potential stocks, outline the entries that you're looking to use, the risk that you'll put on per position, the position sizing. Then on terms of daily routine, you can practice situational awareness, visualize what can happen that day, how you'll respond. And then, previously I've given a similar presentation to this and I said focus on less than 5 names. I adjusted that down to 3 names because that's what I found personally has been one of the best things I've done personally in my own trading is focus on less, focus on, only 3 names pretty much each day, the best of the best names, and just kind of disregard everything else until, your trading is done for the day and you can kind of analyze the market as a whole. But focusing on less stocks on your focus list allows you to execute so much better on the stocks that you do choose. It's no good watching 15, 20 stocks when, one of them might have been amazing that you missed it if you only were focusing on three. But the key thing is you wouldn't have executed well on that stock that did well because you're trying to watch too much. You're trying to watch all these charts and everything's happening at the open. You guys know how hectic the open is. Everything's moving on volume, and you really have to be very selective in the best setups, the best entry tactics that you can use. And then you want to use the technology that you have. Use something like DeFi where you can set alerts just below key pivots, so you don't have to watch everything all at once, and you're gonna set yourself up for success and have a better chance of catching a stock at the proper buy point if you use alerts. So make sure you're using those to the fullest ability, and then just go ahead and execute. And after you're done, review your trades, think about what you could have done better, pick the top setups for the next day, and just kind of move on and gradually improve. And we've got a quote here from Jim Rohn. Discipline is the bridge between goals and accomplishment. So right now, if you've got some goals when it comes to trading, to become a market wizard, to win the USIC, whatever it is, you have to set yourself up for and build a system for yourself that allows you to get there. And then you have to be disciplined enough to execute that system. Without the system, without the discipline, you're not going to reach the goal. It's as simple as that. So you have to have kind of all three of those components and dream big for sure, but set yourself up for success and be realistic, and then also be ruthless in how you execute that system, so you put yourself in the best possible situation. Lesson 8, sell systematically and objectively. Selling is one of the hardest parts of trading. It's always going to go up more when you sell. It's always going to, if you don't sell, it's going to break the key moving averages and take you right back to your entry. But the key thing is, you got to follow your rules. All the top traders who I've interviewed, they've got a system for when to sell, and they just kind of execute ruthlessly. Again, you have to decide whether you're going to be selling into strength or weakness. I would say the shorter your time frame, again, going from position trader, long-term investor, position trader, swing trader, day trader, the shorter your time frame, the more you probably want to sell into strength, and because your edge is kind of in turning over your edge a lot if you're shorter term, versus if you're longer term, your edge is kind of built by sticking with a strong performing stock through the wiggles and jiggles, as long as it's still doing, it still has a strong longer term trend. So it's kind of different objectives, momentum moves versus duration moves, as I think Pradeep likes to say. Focus on your statistics. If your average gain is 10%, and you get a 20% winner, and your edge is kind of a 3-to-1 with a 10% gain, look to sell some in strength, lock that trade in, and then let the rest ride. You can use moving averages to kind of define a trend for your system if you want to, hold and sell into weakness. I really like the 21 EMA. I think it's amazing how it catches the majority of the moves from base to base. Check it out on, past historical winners. It just kind of works. And then just kind of develop a repeatable and consistent method. Study your winners, stick with the trend. For me, I like to use two closes below the 21 EMA in a strong market to define kind of my exit, or the 50 SMA. That's excellent as well, especially early on in a bull market, to really give a stock room to work with. I personally don't have really the personality and patience to sit through a base, longer term base where it's pulled back 20, 30%. That's why I like to use the 21 EMA to get me out when that, intermediate term momentum move has happened. And then, if it sets up again within the base at the right hand side, I'll then go ahead and jump back in. Whether the price is higher or lower, it doesn't really matter. It's a new trade for me at that instant. Lesson 9, concentrate into positions. This is one of the biggest takeaways, that I had, getting to interview all these top traders, is they would really position size pretty large in their highest conviction names. We're taught, at basic financial literacy, investing, whatever, to spread out your bets, so you can't, go broke on one investment. But it's completely different story when it comes to trading because you're managing risk through your stop losses, your entries, all of that. You're not trying to diversify. You're trying to concentrate in the strongest names that in itself is going to provide some safety. It's of course no sure thing, but position sizing large into a strong stock with tight risk management is taking care of that risk management. And it also allows you to, when you catch a winner like SMCI or Nvidia from 2024, 2023, it really moves the needle and gets you that cushion that then you can use however you want to invest in the next stock, or what have you. And less positions allows you to focus more on each one, which again allows you to execute better overall. So the top traders who I've interviewed, most of them trade 2 to 10 positions. Many of them trade 6, 7. They often have sizes of 20% or more in high conviction trades. Some of them are much more than that, 60%, 80%. They're on full margin and they're putting half their account in one stock, half the account in the other. Now, to do that properly, you have to know how to get into those stocks while managing risk. You're not just kind of blindly, I'm going to put half of my account in this stock and hope it works. You're using entry tactics to keep your risk really low if the stock does move against you and doesn't do what you expect. Less stocks also allows you to learn how each stock trades, so you notice character changes both to the positive and the negative. Just a few strong stocks can make your year, but again, you have to manage risk tightly with tight entries, entry tactics to manage risk. Otherwise, you can't position size that much higher because you can't take many 10% losses on a 20% position in a row. You have to cut losses a lot shorter than that if you're going to be successful while sizing pretty large. But this is one of the biggest keys to getting super performance, is being able to confidently and while managing risk, concentrate large position sizes when the market is right and everything is lining up at the start of a new uptrend, in the start of a new potential market leader. Lesson 10, we've kind of gone through this a little bit, but it's worth going over again. Conduct post-analysis. Identify your weaknesses. How many baseball players or football players watch game film? Why do they do that? They do that to identify the weaknesses and identify the things that they can change that will help them win more games in the future, get more hits in the future, hit more home runs in the future. It might suck to watch yourself strike out, but if you notice your Achilles heel, a tell that you always swing at, curveballs, outside and low, if you just eliminate that, you'll put yourself in a better spot mentally as well as physically later on at future at bats, because you know your weakness, you know what to avoid. And just like trading, if you just eliminate the stuff that you're making most of your mistakes on, your performance has to improve. And that's such a big key. And this is true for investing. This is true for trading. Study what you did right, what went wrong. Did you follow and execute your plan? What could you change about your plan in the future? What were some of the common aspects of your best trades? What about your worst trades? What is your average gain, your average loss? Are you cutting losses properly? What can you improve on? What rules and routines can you create to do so? It's all about kind of putting in the work, analyzing yourself, analyze your performance, so you can overall, improve incrementally through studying yourself. There's a reason the best athletes do this religiously. It's because it's the number one thing that they can do to improve their games, and we want to do that same thing as traders. So here's my homework, my additional homework for you guys. Go back and study Nvidia's move from early 2023 to 2024, because not only is post-analysis studying your own personal trading, but it's also about studying the best opportunities that were available for your system during a set piece of time. So if you missed SMCI, you missed Nvidia, but you should have gotten it, you got to analyze why, so you can catch the future ones. So go bar by bar. On each bar, would you buy, hold, sell? How much? What is your kind of mental expectation for the next bar? What were some key price and volume characteristics? Which setups worked? What entry tactics? Where would you have entered? Where would you have exited? What news theme drove the move? When did those come into the marketplace? Summarize this exercise in a report. You might just make your own model book, which, if you haven't made one yet, is awesome. And if you do this exercise, tag me and TraderLion on Twitter. We might, for people who do this, we might be doing a giveaway. No promises, but we'll look to do that. And just doing this practice will teach you so much about how true market leaders move, what gets them started, where you can enter while managing risk, which is so important. And studying the top opportunities just allows you to improve your system, improve your routines, so you can catch the next leader like NVIDIA. All right, so we've covered a lot of lessons today. Hopefully there's been some golden nuggets in here. Let me know in the chat right now kind of your favorite lesson that I've covered. But here's kind of a lot of it summarized into a template for trading success. Pick one trader, one of the conference speakers from this year, who you most relate to and whose style most matches yours. For me, it was Oliver Kell. I got to work with him on the masterclass that we did and really get to talk with him immensely. His price cycle completely changed how I interpret price action and trade. And my style, I related a lot. Everything he said made sense. So if there's somebody who has a similar effect for you, kind of choose them. Study interviews that they've given, books they've written, articles, master classes like we have at TraderLion. If Stan or Oliver is the person for you, look for what criteria they use for stock selection, what setups do they use, how do they size, how do they manage risk, how do they sell, what market conditions are they most aggressive in. Pick one setup that they use, trade it and research it for yourself, collect historical examples, build model books, and then just apply what you've learned through all of this, and use that as your foundation. And you're not going to be trading it as successfully as they are to start with, but you'll have a huge leg up in terms of if you otherwise just kind of went and did random things and try to figure everything out for yourself. Start with the foundation of success that they've already built, and then add your own spin to it as you gain experience and gain more know-how. So pick one setup, trade and build confidence, learn the nuances of the setup, how they trade, how you trade, manage risk. And again, this takes time. It could take, 1 or 2 market cycles at the very least. And over the course of your career, you're always going to be learning. There's people who I've learned a lot from, for instance, Eve Bobach, who's been watching this conference and has texted me that it's been amazing getting to listen to these speakers. She's been doing this for years and years, is extremely successful managing a fund, and she's still out here learning. And that's ultimately why she's successful, because she has that passion and drive to learn and improve and gain whatever edges that she can, even though she's already, made it to say that. So you can always get better. There's always something that you can improve on and something you can work on. And lastly, to channel my inner Ryan Pierpont, you can do it. If you listen to the stories of great traders, they all started knowing nothing, struggling. Every trader, I think, has gone through periods where they feel like, oh, I can't do this. I've got this huge drawdown, but you just have to persevere, look to improve your system, and really change things. If you're not performing well, you have to put in the work and identify what you need to change to be successful. But even if you're on the right path and managing risk and all of that, there's still going to be periods where you're feeling down. You feel like you can't quite be successful, but you just kind of have to put in the work. Study the great traders, study the great market cycles, study stocks. Again, we did the masterclass with John Boyk, where we basically did this. We studied every market cycle, and John kind of guided everybody through all the market cycles, what drove them, how long they lasted, how do they start, how do they end, going all the way back to, the early 1900s. And then we also studied great traders, how they traded during those periods, the great stocks that they traded. So studying all these helps you build that historical template that then you can apply to current markets and of course adapt, but it provides you with that great foundation. So again, these traders, they went through turbulent times of success and failure. They persevered, they kept at it. And if they can do that, so can you, especially because you've got access to way more resources than they did. You've got access to books they literally wrote, videos they made nowadays. So if they can do it, so can you. And now remember, go ahead and do your homework here. I expect to see a lot of responses. And again, I kind of mentioned this earlier, dreams stay dreams until you act. So go ahead, set a plan. Don't just watch this conference, study it. And to really study something, you have to apply it. It's no good studying a resource or saying you're studying a resource unless you actually apply the key takeaways from it. So my challenge to you guys, everybody watching, Take one golden nugget from this conference, whether it's a setup, whether it's something about risk management, and go ahead, build a rule around it and use it in your trading next week. That's kind of my challenge to you guys. So with that, thank you guys so much. It's been a pleasure to present at the conference. Hopefully you guys are enjoying everything. And if you are, please go ahead again, leave a like down below on the stream, subscribe to the channel. We've got amazing resources coming your way. Great to have you guys here. And I think at this point, we'll go ahead and close it out, and we'll be right back with the next presenter. So again, thank you so much. Leave a like down below, subscribe to the channel, check out the many resources that we have here, as well as over at TraderLion University. Again, if you sign up for the free VIP, you get access to all the slides that not only I presented, but every speaker, and you get access to model books, other free resources, conference resources, podcast resources that again help you study the greatest traders, the greatest stocks, and market cycles. So don't miss out. Sign up for a free account, check those out, and we really hope sincerely that it helps you shorten your learning curve. So go out and do it. And I hope to see a lot of people's homework on Twitter over the next few days. Maybe the person who posts it first, I'll give them a special something as well. So thank you guys all for tuning in. Hopefully this is helpful to you. We know it can be a little bit overwhelming, all the different presenters, over basically a month at this point with the TraderLion conference. But the key thing is to really focus your attention on what can help your trading the most. Maybe it's not even somebody who trades like your style, but they said one thing that can really help you and you can apply. So just add that layer to your process, see if it sticks, and just make those incremental improvements. So thank you guys again. And we'll be right back with the next presenter. Stay tuned. Okay, welcome back, everybody. I'm really excited to introduce the next speaker for the TraderLion conference. We have Eric Krull, who is an extremely experienced money manager. He's one of the co-authors of the Lifecycle trade, which was an in-depth study of what creates super growth stocks, as well as the IPOs that can go up and double 10x ideally. And he's also one of the great educators as a part of the IPO Masterclass. Today, he'll be talking about the Lifecycle trade advantage, give us an update on the IPO markets, and also dive into his process for finding these winners as well as position management. Eric, thank you so much for being a part of this. I've been really looking forward to this.
Well, thank you, Richard. And I'm really happy to be part of it. Thanks for inviting me. And I hope to pass on some information I've learned over all the years of studying not only stocks, but specifically IPOs and also the life cycle trade.
Yeah, perfect. Let's dive right in.
All right, great. As you can see from the opening slide here, we're going to talk about the life cycle trade advantage. And I'm going to also go into some details about screening and trading of stocks. Before we begin, I definitely need to talk about the disclaimer here. This content is for informational and educational purposes only. Nothing contained in this webinar should be considered to be financial advice or trading advice. It's always up to you to do your own due diligence and also contact a licensed financial advisor if you don't feel like you know how to do it on your own. And reproduction and distribution of this content in any form is prohibited. The other thing I'm going to just make sure is that everything in these slides is considered to be accurate. There may be slight mistakes here and there, but for the most part, everything that's shown here can be considered to be good educational material. And again, it's not any specific stocks I mentioned or any watch list I show. Do not take those as stocks that I'm interested in buying or that you should be buying. All right, a little bit about me. I've been a full-time trader since 1999. I've been a hedge fund manager for 14 years. I trade stocks and options. I used to trade futures, but not so much anymore. I've been part of two great groups that have helped me not only become a better trader, but also I made a lot of friends from these two groups. I was part of the Naperville IBD meetup group from 2003 through 2014. And then I joined the Pilot Investors group when the group transitioned over from Naperville. And I was part of that from 2014 until early part of this year. I've been a TradeStation user since 2004. I've been to many Investor Business Daily seminars. That's where a lot of the things I learned came from. I've been to some of the seminars multiple times. I also have an MBA from the University of Chicago, where I studied both finance and investing and marketing. And you can see on the right there, I was featured in an IBD investor profile back in 2008 when they talked about a couple of my trades, specifically one of them in RIM, Research in Motion. The agenda for this webinar is I'm going to give you a quick overview of the life cycle advantage, because I think by now most everybody who's watching this is familiar with our book and has maybe heard some of our other seminars. I'm going to talk about how I do watch list management and also show some of my screens that I use to identify what I consider to be either the best IPOs or also as I'm looking for super growth stocks. I'm going to cover the current state of the IPO market. I'm talking here middle of July in 2024. I also will talk about how I trade, to go over some of my daily routines and also my risk management. I'm going to go through a few trades in the IPO advance phase. That's the early part of a stock's life cycle. And I'll specifically show the Everest Rule results. And then I'm going to also, after the end of all that, just show some lessons I've learned from all my years of trading and from my experience. And at the end, of course, we'll have some questions. So a brief overview of the life cycle advantage. We talk about life cycle advantage with this great acronym LIVES. First, nearly all IPOs have a life cycle in three distinct phases. The IPO life cycle patterns that we identified are late bloomers, pump and dumps, stair steppers, rocket ships, one-hit wonders, and disappointments. We found most stocks fit into one of these categories. And sometimes stocks will transition from one pattern to another. Don't get too hung up on the patterns. The main thing is you worry about how you trade them while they're in the patterns. We also talk about volume. We really think liquidity matters a lot. We don't trade stocks unless they trade greater than $20 million of volume per day. We talk about dollar volume, and you get dollar volume by taking the average number of shares traded over the last 50 days times the current stock price. And that's how you get how many dollars of volume are traded per day. We look for exceptional companies that are disruptive, transformative companies, and they drive how we do things in terms of how we work, play, and live. Those can be big growth drivers. And then we also talk about sell rules in our book. You have to use the appropriate sell rule for the appropriate life cycle phase. When you're in the beginning, a quick growth phase, you want to have faster rules. You don't want to use slow rules when a stock first comes out public. So let's talk about the life cycle phases real briefly. This is a stock chart. It's a weekly chart. When you see it, when a stock comes out in public, it begins this IPO advance phase. So it becomes public here, and it starts to go up, and we call that the IPO advance phase. You'll see it's marked there with that arrow. After it advances, many times stocks will then come into a long-term phase where they go down and up and down and up, and they really just kind of churn. And they tend to fall into this pattern that we call the due diligence phase. This is where institutions are researching the stock, and frankly, what they're watching for are the earnings and sales over many quarters. Will this stock actually match what they promised when they went public? Will they have the growth they expected? Will they have the earnings they expected? And really, after 2, 3, 4, maybe 6 earnings cycles, then the stock might take off. Many times what we find in this phase is the stock finds resistance. Notice how the stock hit a peak over here. It started to approach and then came back. It got closer, then came back, approached again and came back. Multiple touches are real close to what we call the turbulence zone. And that's the old prior high. And once the stock kind of gets close to that, sometimes it'll go above it and then come back and check below it. And then eventually it might jump up and start the institutional advance phase. And that institutional advance phase is where institutions now start to accumulate shares, because based on, usually it's something to do with earnings or sales, something happens that makes the stock just take off. And this isn't just retail investors like us at home. These are institutions who need to get millions and maybe billions of dollars into a stock, and they do it over a long period of time, and they drive the price higher. And that's the institutional advance phase. That's the phase you want to get in on and have a large size in the stock when it does that. Here is just a quick thumbnail view of the life cycle patterns that we identified. Now, many stocks won't look exactly like these, but they'll be close. And you can see, like the late bloomers, they come out and then they take a long time before they finally take off. This might be 2, 3 years. The pump and dumps, they come out and they immediately undercut their day one stock price. That's what the line is, the day one close. It undercuts it, and it may stay low like this. In this case, this graph is 18 months. This happens to be Facebook. It took 18 months before the stock took off and started to advance. One-hit wonders are stocks that maybe they noodle around a little bit near their IPO price, and then they take off. They make a sharp, quick advance where you can actually make some money on it, and then they fall down and undercut their day one low, and sometimes may never come back. And that's why we call them one-hit wonders. This is the graph of Shake Shack. Ultimately, as time went on, Shake Shack did come back and go even higher. So we call that a one-hit wonder plus. But many stocks, sometimes they have their one heyday and they're done. Rocket ships are stocks that come out and they maybe just noodle around their day one price for a little while, and then they take off like a rocket. You feel like you can't even catch on to them. You're waiting for a pullback to buy, and it never happens. This happens to be eBay, where it went up like 400% within a very short period of time. And then we have the stair steppers. We thought when we were doing our study that we'd see a lot of stair steppers. It turns out this is actually kind of a rare pattern. This one happens to be Google, where the stock comes out, goes down a little bit, and then it jumps up and forms a nice little flat pattern, which is a stair, then takes another step up, and then it forms another flat pattern and goes again. This is a rare pattern in that we don't see too often, because most stocks undercut their day one low and go into a long due diligence. We think Google never went into to due diligence. It just went right into the institutional advance phase, and that does not happen often. And then there's stocks that are disappointments. They come out, they might have a little hype, or maybe never even hears about them, and then they go down, and then they never come back. This one happens to be Potbelly. Potbelly, if you looked at it now, it's probably still below its day one price. I haven't looked at it in years. It's come out and gone nowhere. I have found many stocks. I think 10% of all stocks end up being disappointments where they just never get going, and they never are stock even to think about investing in. So I'm going to summarize a little bit more of our book, some things I didn't even show here today. The truth about IPOs. Few stocks make big gains very quickly in their initial public offering. One of the reasons we wanted to study IPOs, our team, was we felt like we weren't playing them well. And we thought, oh, we missed the good ones. And then as we really dug into it, and we studied over 2,000 IPOs, we found that in 4 weeks, only 1%, 1.3% double in their first 4 weeks. That's really a small number. It's nothing to worry about. You're not going to miss many. It's only 6% double within 13 weeks of their first quarter of trading. After a year, only 30% of all stocks have doubled after the IPO. And ultimately, it leads to, after 10 years, about half of IPOs eventually turn into doubling. And all this table really shows you is it takes a long time for most stocks to double. So don't be sold on the hype. And most IPOs undercut their day one low. We found that within 3 weeks, over half the stocks, 55%, undercut their day one low. After 39 weeks, 13 weeks, 3 quarters. After 33 quarters, 82% have undercut their day one low. And after 2 years, eventually, 91% undercut their day one low. And what that means is this. Some stock comes out, you get excited, you think I better buy, I don't want to miss the next Google or whatever you think it's going to be. You don't have to buy it right away. Most of them are going to undercut their day one low, and most are not going to double in a short time. So patience is key. So here's a summary of the reasons for patience, both in things I've shown you today and things from the book I haven't shown you. Few stocks make gains of more than 100% or more in a quick matter. Stocks that do advance quickly will most likely give back all their gains. I didn't show it today, but we studied the ones that did go up quickly. They give up most of their gains within within the first 5 months. 55% undercut their day one low within 3 weeks. 91% eventually undercut their day one low, and only 28% of all IPOs are liquid enough to trade. I didn't show you that today, but that $20 million a day of volume, only 28% of of all stocks ever get there. And one thing I also didn't talk about today, 11% of IPOs achieve their all-time high within 10 days and never go higher. Think about those disappointments I talked about. So with all the bad news about IPOs, why would someone even bother with them? Why would you even consider them? Well, the answer is because a few good trades in an IPO that goes on to a super growth stock can change your life. We found 69% achieved gains of over 50% or more, but you really want to get down to this level here. 19.5%, almost 20% achieve gains over their lifetime of 400% or more. 10% go on to a gain of 900% or more. And there's a special 5.2% or about 1 in 20 stocks can achieve a gain of over 2,000% at their all-time high. You catch 1 or 2 of these ones and you can change your life. So let's talk about watch list management. How do I find recent IPOs and potential super growth stocks? Because we all want to get some of those 10 baggers, or even better if we can. So here's the screens I use. I happen to use a market surge program from Investors Business Daily. It used to be called MarketSmith. Now it's called Market Surge. And I just run a rough screen where I check for recent IPOs that are above their 21-day exponential moving average. I block out ETFs. I don't want SPACs. I don't want REITs, but I do check for liquidity greater than $20 million a day. You can see that I chose this over here. I went from back to 2019, and you can see the day I ran the screen, there were 53 stocks that met the criterion. And it's pretty easy to go through 53 stocks and just look at them. If you want to get the best of the best, I look for stocks that are recent IPOs with the same criteria as above, except I also add additional criteria like I want them to be in a short-term uptrend above their 10-day simple moving average, their medium-term uptrend above their 21 EMA, and more of a longer term, I want it to be above their 50-day moving average. And I also want the relative strength line within 5% of a new high. When I do that, it takes that bigger universe of 53 stocks and it gets it down to just 14. And anybody can study 14 stocks in depth. That doesn't mean these stocks are guaranteed to be good, but it's a way that I run the screen and help me identify stocks. And I run this pretty often so that I'm always aware of stocks that meet the criteria. On a weekly basis, I also run a high relative price strength. I run this one in TradeStation. I just check for stocks about $15 a share. And I'm going to see stocks that have beat the S&P by over 20% over the last 4 weeks. And I also check for liquidity. I just want to see stocks that are doing much better than the main index. And lastly, I also run some other programs. I try to find rare jewels that we identified in our book. Rare jewel is an IPO that gains more than 100% within 90 days of going public. Many times they'll correct, but we find that in the long run, rare jewels, if they go up 100% or more within the first 90 days, even if they correct, they typically they have a much higher chance of being a big winner in the long run. So I watch those. And I also look for IPOs that are trading 30% or more off their 52-week low. This is where you can find stocks that maybe went up, came down, undercut their day one low, and bounced around in the due diligence phase way below where they came out public. If they start to get 30% off their lows, they might be starting to get out of their due diligence phase and getting ready for an institutional advance phase. And so you want to check for those that maybe fell off your radar because they didn't look good, but now they're starting to come back. After, I don't care how many screens you run, when you're all done, I recommend keeping your watch list below 100 stocks. And the reason is it's very difficult to keep track of a lot of stocks. And you can't really, I can't handle more than 100. And in this case, you can see I had 54, including some indices. This is at least a year old. So none of these stocks are ones I would recommend watching now. I'm just saying that you want to watch your stocks, see how they're doing, and also look at industry groups to see what is leading, but spend more time on individual stocks than industry groups. Industry groups are great. You like to see a bird flying with other birds on the same of the same feather, but sometimes you'll get a stock that's doing great in a bad industry group. So I spend more time on stocks than I do on industry groups. Okay, so that's a little bit of how I screen. I give you a little bit of background on the life cycle. Let's talk about the current state of the IPO market and also specifically IPOs I'm watching right now in mid-July of 2024. Now, the IPO activity has been really, what's the word I'm looking for? It's very light. It's been very cold. It's a cold IPO market since 2021. You can see over here, this is the IPO market by year. I get data from Renaissance Capital, and you can see that over time from 2016 through 2021, it grew every year. If you recall, in the 2020 year after COVID, the market had an unbelievable recovery and a lot of stocks went public. That was the highest amount of IPOs that had gone public in 6 years. And then in 2021, after 2020, there even more went public. And believe it or not, this bar here, which shows a huge amount of market capital raised and 397 IPOs, which was the biggest number up to that point, there were a lot more SPACs that came out that year. And the vast majority of SPACs ended up being nothing to invest in. But they're not even shown in this graph. There were like 440 SPACs in addition to these 397 IPOs. So 2021 was like the blow off top and companies going public. And what happens after a blow off top? Typically, hardly anything happens. If you recall, we started a bear market in 2022. Companies don't like to go public in a bear market. And that was certainly the case after the blow off top. When the SPAC started to crash and turn out to be bad investments, or the vast majority of them, companies didn't go public. Investors didn't trust companies that went public, so there was no appetite. And since 2022, it's slowly growing. It got a little better last year, and as of July of this year, it's a run rate better than 2023, but it's not really super fast. You can see on the right by quarter, you can see how many stocks went public and how much money they raised. And you can see this year, first quarter and second quarter, it's running ahead of the quarters of last year by a little bit. So the IP market is thawing a little bit, but it's still pretty much ice cold compared to other years. The other thing that I've noticed is the IPO quality since the beginning of 2022 has been below average. And what's one way to determine that? And that's how liquid they are. Our original research showed that 28% of all stocks eventually trade more than $20 million a day, but 72% don't. And these 28%, that's the institutional quality stocks that drive stock prices up. You can't get a stock with little institutional ownership that go up a lot. So you want to find the ones that get a lot of institutions in them. And that's only about 28% of all stocks. Well, guess what? Since the stocks started debuting in 2022 in January, only 13% of them trade more than $20 million a day. That's only about half of the normal amount of IPOs that we saw in our research. And so to me, that just shows it's a sign of the lower quality IPOs in the last 3 years. Of those IPOs that have come out since 2022, January, these are the best ones. These are ones that all trade more than $20 million of volume a day. You can see the volume on the right, far right here. And these are the ones that have gained the most, that trade more than 20 million a day. And there's only 18 of them. My criteria was also, I wanted to see stocks that gain 20% or more since they went public. And you can see them all here. There's a few that we're going to talk about in a few slides here. I'm going to talk about ARM Holdings and Kava Group. Maybe you've heard of some of these stocks. Reddit, probably. Birkenstock, Viking Cruises. So there's some good ones in here. One at the top, Nano Nuclear. I'm excited about this company. Do not invest in it because I said that. This is a company that has no sales and no earnings. So this is just a really small probability story stock. I'm watching it for one reason. They make portable nuclear power plants that fit on a semi-trailer truck. It's a very exciting opportunity if these things ever start to get used or approved. The whole idea is this. It's carbon free energy that can be moved almost anywhere in the world where there's a road, and you can move it relatively quickly. If this ever takes off, this could change the way we live, and we'll see what happens. No sales, no earnings, highly speculative. Do not invest in it because I just talked about it. It's something to watch. Here's IPOs I'm actually trading or watching closely. Kava Group, I'm in this stock. I'll show you where I traded it in a little bit, but you can see on a weekly chart here, it had a nice IPO advance, and then it came down, undercut the day one low, like 91% of all stocks. It started to come off the bottom. It formed a little handle here, then it broke out, and it's been in a nice uptrend ever since. ARM Holdings, they're a chip company that used to be public years ago. They went private, and then they came back public. They're based out of the UK. So it's kind of like a new stock, but it's not really because it's an old company. I was very curious at how it's going to trade. Will it have an IPO advance, or will it be like an institutional advance because it's an old company? But so far, it came out, went pretty quiet, and not much movement for a while, and it broke out, and then it really broke out, and then it had a huge correction, which probably scared the vast majority of people, including me. And then it came back up again. And then Reddit, a company that's been trading only for a few months here, it's had a choppy existence. If you close your eyes and ignore the second week, I look at it like it came down, undercut its day one low, kind of formed an IPO base, formed some choppiness in the turbulent zone above here. It kept checking the old high, and then it took off a little bit. I'm watching it. I'm not in it. It doesn't trade the way I like, but it's a stock I am watching. It looks like it might be continuing its IPO advance phase. Here's some stocks. I have to give credit to my friends Eve and Kathy, my co-authors on this book, Kathy Donnelly and Eve Bobach. They both pointed out these stocks as ones that we should be watching, because on a monthly chart, you get a better perspective of where are they at in the life cycle after they came out at a higher price, and then they formed this due diligence phase, and they're coming off, this one on is coming off the bottom. It's already formed a base and recently broke out. This would have been a good one to buy a few months ago when it broke above the old high, because to me, this is the due diligence phase and the first base off of that. It looks like it might be beginning its institutional advance phase, despite the fact there may be turbulence. Notice how even on a monthly chart, you see the old high here, that high, and how it's running into turbulence. Hood, which is Robinhood, they also came out and then really undercut severely their beginning prices, formed a due diligence phase bouncing off the bottom. And this one qualifies as, hey, it would have showed up and you're checking stocks that are 30% off their 52-week low, and maybe you identified it as maybe it's getting better. It's to me looking like it's still in the due diligence phase. Maybe if it goes sideways for a little while and breaks out, I'd consider buying it. Dutch Brothers, the symbol is BROS. It's still in the due diligence phase. It's one to keep an eye on. Maybe it'll form a little bit of a handle and break out. But again, that would be beginning of an institutional advance phase.
And Eric, sorry, just jumping in quick. If you go back one more slide, it looks like all three of those kind of have a nice increase in volume recently. Is that something that you guys look at as a part of the lifecycle trade methodology?
Yeah, Richard, great point. And it is. If you were to look at this, what we'd like to see, in addition to the $20 million a day in average daily volume, we'd like to see, as it starts to rise again, an increase in the volume. And we call that also a liquidity tell, where when trading volume picks up and the advance begins, it's starting to draw institutions in, and they're the ones who drive volume. Right. Coinbase, similar pattern, similar effect. If it were to break above this high of about 5 months ago, I would be looking at that one seriously. And Palantir, this is a stock I've been in and out of over the time. And it's getting close to right above that old high here of almost 2 years ago. And it's, to me, looking like it might be starting its institutional advance phase. And believe me, the institutional advance phase is where you want to be. I mean, you can make money in the IPO advance phase, but it's usually short and you have to act fast. And it is not as long in terms of gains, or it's not as high in terms of gains as the institutional advance phase. Okay, so let's transition from the current market of IPOs to how I trade. I'll talk a little bit about my daily routine, how I trade, my main overview, risk management, how I use stops, and position size. My daily routine, I think everybody should do something for their physical body. You can work out. People like to swim, bike, walk, lift weights, whatever. You should do something for your mental state. Some people like to do reciting positive affirmations. Some people like to read motivational material. Some people do yoga, meditation. I happen to go to daily mass. That helps get me in the right frame of mind. I check the futures in the morning and my stocks, how they're acting pre-market, because I want to know what I'm in for. I just want to see where it's at. So I'm not like turning on the screen and then I'm scared. Today would be a day I'm scared. During market hours, I do things like I watch this program, IBD Live. I run scans. I take frequent breaks. Don't be married to the computer. The more wiggles you watch, the more likely you're going to trade. That's not a good thing. I trade options for hedging during the days, depending on how my stocks are doing. And on a weekly basis, I do something a little bit different when the market's not open. I write on a calendar when earnings are going to be reported for the following week. I do it on paper. I make sure I look up my stocks. I get those on a calendar, because you never, ever want to miss a day where one of your stocks that either you own or that you're watching closely announces earnings and you're not aware. It's happened to me once or twice. Once it happened, I never missed it again. You don't want to miss it because that's a volatile time. I used to do the IBD and investors group meetups, the pilot investors group. For them, I would do a weekly recap, and it gets me to study the market, how our sector is doing, how is the market doing, how are stocks doing. That way, I'm always aware of what's kind of like health the market has. I do something I call the Ride the Wave plan with some friends. We meet every Monday. I highly recommend you involve yourself with other people who trade like you, who are like-minded. And what we talk about in the Ride the Wave plan is how's the market, how are leading stocks, what are leading industries, and what are we specifically doing. And I text and talk with trader friends all the time. That way you're never too far out of touch, because trading can be a lonely business and an individual business, and you want to make sure that you're not too far off the reservation, as we like to say. You want to make sure if you're thinking one way, but everyone else is thinking another way, you won't know that unless you check in with someone else. So let me summarize how I trade. I'm a growth stock investor. I mainly go long. In rare occasions, I'll go short, but I go long. I use options to hedge around earnings dates. I also try to find the best stocks with high relative strength, high earnings growth, high sales growth. I run a concentrated portfolio of 5 to 10 stocks. And you may have heard the term, don't put all your eggs in one basket. I put my eggs in very few baskets, but I watch them like a hawk, as I learned from Bill O'Neill. I invest heavily when the NASDAQ market trend is up. To me, that's when the 10-day simple moving average and the 21's exponential moving average are in uptrends. And when the index is more than 1% above the 21 EMA, that's an uptrend. My risk management, in the institutional advanced phase, I do it typically like this. I sell a third of the position if I'm down 3%. I sell another third when I'm down 5%. And I sell that last third when I'm down 7%. Sometimes, and over the years, I sell even sooner. If the market's good, and a lot of stocks are good, but my stock isn't, that's a sign there's something wrong with that stock. So I sell, and sometimes more than this, quicker than a 5% loss on average. The other thing is I frequently hedge with puts, especially around earnings. In the IPO advanced phase, the early life of a stock, I don't hedge with puts. They're usually too expensive, and sometimes new stocks don't even have puts available. And I also try to just wait. There's a lot of volatility in the IPO advanced phase, and so selling at a 3 to 5% down is usually too fast. So I start with a smaller position, and then I use a 10% stop. So I still manage my losses by making sure if I'm letting a bigger percentage loss happen, that I have a smaller position. I can summarize my management guidelines with this table. I won't read every line, but certainly you can stop the screen and just look at it. But if it's in the IPO advanced phase, I typically limit myself to just 1 or 2 stocks and a smaller position size of 10% of my capital or less. I try to buy once and sit still. In the IAP, institutional advanced phase, you can invest in as many stocks as you want. Like I said, I go 5 to 10. I use that stop loss rule I talked about. A typical position size is I try to achieve a 20% position size. And I get there by buying my pyramiding on winners. I might start with a 10% position. I go up 2%. I buy another, 6 or 7% of the position. And then if I'm up another 2%, I buy the remaining shares to get up to a 20% position size. All right, so let's talk about some trades in the IPO advanced phase and expectations you should have, how I manage risk, and taking some profits. Now, the IPO advanced phase at the peak for liquid IPOs over the last 3 years or so, the average number of days for the run is like 90 trading days with a median of about 11 weeks or 55 trading days. The average price move from the first trading day low to the peak is 129% with a median of only 72%. The average is much skewed because of a few big winners. Your expectation should be this. You should watch them action closely because you can stop out quickly. That's because there's a lot of volatility. It may take you several tries to get a position in a recent IPO due to the volatility. A shakeout is normal. Keep your average true range in mind, like how much the stock moves on a daily basis from low to high, including gaps from the prior day. And make sure you know that average true range when you start setting stops and looking at entries. And be aware of the lockup expiration period about 6 months after an IPO, because sometimes that causes volatility to surge. So to summarize, I manage risk by trading IPOs only in a strong bull market, which would be, I would consider now to be one, or in a new bull right after a bear. Trade only 1 or 2 IPOs at a time, reduce the position size by one sit still, and never risk more than 1% of your capital on a trade, sometimes and ideally much less as you become an experienced trader. And use fast rules in the IPO advance phase because, like I said earlier, many times they go up a lot in the IPO advance phase, but then they give it back quickly. From our book, we use 2 rules. I won't go into details here, but we just call them the Everest and Ascender rule. The whole idea is you're trying to take profits into strength. And you want to make sure that you sell into a parabolic move if the stock just takes off. I'm going to show you a couple of those trades on the Everest rule, but the whole idea is you want to make sure in the IPO advance phase that you grab some of those profits because they're fleeting. If you want to know more about these rules, I would take the TraderLion Masterclass on IPOs or buy the book. So let's look at some real examples of the Everest rule. This is a stock called IQ. You can see it IPO'd over here. It had a nice IPO advance phase. In this case, I don't remember where I bought the stock. I think it was around here, but it took off and I got an Everest sell signal trigger over here at the pink dot. That does not mean you sell there. It means you now put in a trailing stop. And that trailing stop gets moved up every time the stock makes a new high. And you can see as the stock went up, the trailing stock went up, and eventually the stock pushed through the trailing stop, and that would have triggered the sell. And luckily, in this case, it turns out that that would have been this the short-term high for a long time. Here's Acacia, another stock that I was watching and traded, and it triggered during this IPO advance phase an Everest sell stop over here on this date. It started the trailing stop. You can see just, I don't know, 10 days later or so, it triggered a sell. And the stock also ended up being a short-term high for this because the stock went down after that. This is a trade I did in Zoom. There were multiple trades I made in this stock. I made 3 buys as I pyramided in, and then I got stopped out over here, and I sold for a slight loss. It broke out soon after that. I brought here, I added here, and soon after that, it was like a day later, I got stopped out. And so I got shaken out of this stock twice in the early stages and had 2 losses in a row. But long term, I got back in it. You can see it had the IPO advance phase. It went through due diligence. I made my 6th, 7th, and 8th buys over here on this weekly chart. I sold some over here when it had this terrible bar down. And then I bought back in. I added, did a partial sale, bought some more, and I sold over here. And eventually I was out. And luckily, counting all the trades I made, I was able to double my money in Zoom. And it's a good thing I sold here because look at what the stock did eventually. Let's talk about some recent trades that I made in the IPO advance phase. And actually, I'm in these right now. When and how did I get into these 2? And these are some of the best of the recent IPOs. ARM Holdings. You can see I bought this stock IPO'd over here. It went sideways for a long time. Went underneath its day 1 low, like a lot of stocks. Eventually, it formed almost like what looks like a saucer base on this chart. I bought here on an advance. It rose up. It had 2 terrible days, and I believe at the time it was the first of the year, and the market sometimes gets squirrely on January 3rd, like the first trading day of the year, and I sold out. Just a few days later, I bought back when it got back above the 20-minute EMA, and then I pretty much held on through this big advance. I got scared on this big, terrible down day, way below the 50-day moving average. And just 2 days later, it bounced off close to the 200-day moving average. I bought back, and I've been in it ever since. Kava Group, some friends of mine made me aware of this stock. It had a IPO advance phase. It came down in August of 2023. Long due diligence phase, undercut the day one low. Look at this long due diligence. Comes off the bottom, more than 30% off the bottom. Forms this, after this cup, it forms a handle. It broke out. I bought some. I added over here, and I've been in it ever since. But this is a stock that's one of the best acting IPOs of the last couple of years. So let's talk about some lessons I've learned from experience of my trading over the last 25 years. Number one, you have to find your personality. Find a strategy that fits your personality. You do need to
Find the
find
personality too.
You do need to find that. But if you fit the strategy that to your personality, you'll do best. Like, are you the home run hitter like Henry Aaron, or are you a singles hitter like Pete Rose? Are you trying to go for the big gains, or are you trying to go for short-term trading? Study and learn from the greats. Buy books. I love the books by William O'Neill, Darvas, Loeb, Mark Minervini, all that. I love the psychology books by Elder and Steenbarger and Mark Douglas. These are just some of the books on my shelf. But you have to read them too. Don't just buy them. And then learn from them. After you learn from the experts, then it's okay to do your own studies before you try to innovate. And that's true of almost anything in life. You don't just learn how to cook day one and say, I'm going to make my own recipes. Or you don't do the same thing with woodworking or painting. You really want to develop a level of expertise, and once you get that, then you can do your own thing and add on and innovate. So I also say trust the experts but verify, and like Ronald Reagan said, trust but verify. I learned a lot of things from the books, but I learned a lot more when I tried to verify. I'm a big believer in must be data driven. I learned that at the University of Chicago, and also learned that from Bill O'Neill and Investors Business Daily. I studied, after I learned all these things, I studied in detail follow-through days. I did a study on the best winners of the year and found that relative strength matters more than you think. I studied drawdowns and came up with the mental capital preservation rule based on just studying drawdowns while holding through bases. I came up with sell rules after studying a lot of different things, including the Everest rule. I really studied how stocks began just recently to study stocks, how they act on follow-through days, and learning a lot of things about how that can help predict whether a follow-through day is going to work or not. And I learned a lot about options and hedging and how it affects my portfolio. But you can't really do those things in the beginning. You have to really become a seasoned veteran first. Success can breed complacency. Sometimes after you're doing your best, that's also when the big slam comes. I remember in Google and Apple and ISRG in January 2006, they all got slammed at the same time in January. They just came down hard, hitting my portfolio super hard. And only after I looked backwards did I see I missed some sell rules that occurred before the big smashing. I think I was just too complacent because things were going so well. It takes time to be successful. Most people, it takes 3 to 5 years to become a good, consistent trader. It's no different than studying any field. It's like, it takes 4 years to get a college degree. It's the same thing with trading. Don't think because you're smart in one area of life, you're all of a sudden going to be a good trader because you're smart on something else. It's going to take 3 to 5 years to become a good trader. It's a much better plan to try and get rich slowly. All the people who try trading to get rich quickly, most everyone I've met who's tried that, they've lost most of their money, if not all of it. It's just as fun to get rich slowly, and it's the probabilities are much higher. Paper trading is mostly useless. I would do it for a very short time at best because there's no emotion in it. You tell yourself, oh, I certainly would have bought here and I certainly would have sold there, but because you're not really trading, you don't know. Learn from experienced traders at seminars or in small groups. That helps accelerate everything. And become a successful specialist. Don't be a serial dabbler. Don't say, I'm going to try stocks. Oh, I'm going to try options. Oh, I'm going to try penny stocks. Oh, I'm going to try futures. Oh, I'm going to try currencies. Oh, I'm going to trade crypto. No, find something, get good at it, and stay with it and get better. The other thing is market health is rarely crystal clear. When the market is obviously strong or obviously weak, it doesn't last very long. Most of the time, you'll see things that say, oh, the market looks good because of this, but there's some negative signs here. Or, oh, the market looks bad, but I see some positive signs. That's how it is mostly. And after spending many years on Wall Street and after making and losing millions of dollars, Jesse Livermore said, I want to tell you this. It never was my thinking that made big money for me. It was always my sitting. And don't let the hype affect you. This is a day Lyft went public. Oh, CNBC had pink lights everywhere. Everybody was talking about Lyft. They had the specialist there showing when it was going to open, blah, 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 blah. Lyft opens up over here. And what does it do? It just starts falling in price immediately. And I could extend that longer to show how the stock over time undercut those prices and went even lower. So what are my key learnings from experience that I want you to take away? It takes years to become a successful trader. Learning from others makes you much better. I credit my friends, Eve Bolbach, Kathy Donnelly, Kurt Dale, and all the people at Investors Business Daily I learned from is accelerating my learning. You must have a routine. You cut your losses quickly. Consider hedging if you learn how to do options. I do my routine includes screening and scanning. I make sure earning dates are marked. And I got to have patience, especially with IPOs, because over time, if you trade every wiggle, you're just not going to become a good trader. And don't be afraid to buy again. My Zoom example shows you that. I think I was sold out of that twice before I finally made money. And never give up. Never, ever give up. You can do this, but you have to be able to work hard and study hard and make sure you're humble. The people who've been trading a long time, I've never met a trader who's traded a long time in the market who's a big braggart. The ones who are big braggarts, they haven't been humbled yet. And you will be humbled in time with trading. Anyway, that's my presentation. I'd be happy to entertain any questions.
Yeah, Eric, thank you very much for that. I think that was excellent. You covered a lot there, which is perfect. I definitely have some questions. First, I just thought of this going back to the last slide. I wanted to hear, I guess, what your favorite lesson that you've learned from each of your co-authors is, Kathy, Eve, as well as Kurt. What's kind of the biggest takeaway that you've learned based on what they've told you or research that they've individually done?
With Kathy, what I've learned the most from her is the ability to hold and for the long term. Specifically, she doesn't trade much. She doesn't sit at her desk all day. She actually does most of her trading through a phone because she's not watching it. And by not watching it, you can stay long term because nothing scares you out. She checks to make sure that what the market's doing, but she'll really check on Fridays and check on weekly charts how her stocks are positioned on Fridays. So I'd say Kathy has taught me that the most. The Eve is interesting, and in terms I've learned from her is really watch stocks that have products or services that you think could be good, and then go sample them. And then she's big on buying things or trying things to see if it's a good company, kind of like the Peter Lynch thing. And she's very good at finding stocks early in their life cycle in the IPO advance phase that are moving up quickly and then finding a way in. I'd say that. And with Kurt, Kurt's a very disciplined trader. Kurt, he's a former Navy Top Gun pilot and instructor. And as you can imagine, someone who's been in the Navy and a Top Gun pilot, he's very disciplined and he doesn't let things rattle him too much. And he's very good on studying and data. And so I remember one time many years ago when I first met him, he did an analysis of bases and he did a great job in analyzing cups and handles and other types of bases and knowing the ins and outs of how much they correct and what they do before they rise.
Yeah, excellent. And for this next question, I want to kind of hear your thoughts on what are some of the best IPOs for people watching this who want to, improve their performance regarding trading IPOs. What IPOs would you recommend them go back and study? And obviously, there's other resources. Your book as well is fantastic, as well as the masterclass was fantastic as well. But if people wanted to kind of put in the work yeah, what kind of homework do you have for people to assign them so they can improve their performance trading those IPOs?
I would study PANW, Palo Alto Networks. It's a good example of a stock that kind of had a small advance and then kind of went sideways for a long time, then took off. Facebook, because that was a great pump and dump. It went nowhere for 18 months and then took off. And then Google, the rare one, because how different it acted. It went up early, went stagnant, stair-stepped up. That's a good one. And then I would say Kava, a recent one, Kava, because such a powerful advance after like a hook pattern where it came down, formed a J hook, and then took off.
And Google, you mentioned Google, of course. The IPO base is excellent to study as well with that one. Really textbook.
Yeah.
And actually, this kind of goes along with Kava. Once you've got an idea on your radar, and I know you mentioned how well Eve does this, what do you do to kind of learn more about the story, learn more about the potential, the total addressable market, so you can kind of think and step into the shoes of an institutional investor and find companies that they would be interested in?
Well, try to find a company that's been in the same space and what they did. Kava specifically, I went to lunch there one time with Eve and also Jim Ropel, and we had lunch and tested it out. But we looked at like, well, what did Chipotle do? Because this is kind of like a Chipotle type restaurant, except it's Mediterranean food. And then you can study Chipotle over the years. How many restaurants did they have? How fast did they grow? And how fast did profits rise? And can Kava do that? Will it be acting like that? Or will it start to peter out quicker? We'll see. And even look at the management team, like, oh, there's some people on Kava who had success in prior companies. So maybe as an IPO, a new company, they can actually get there. So that's kind of a thing I would do.
Yeah, perfect. And if you don't mind, I had one more question about Kava, but more about the chart and the entry that you looked for. So could we go back to that slide? I think it was, sorry to make you go all the way back here.
It's all right. It's just punching a button. There we go.
So this is kind of, using Kava as an example, but maybe, generalizing it to what you usually like to do. When a stock starts moving up the right-hand side of the institutional due diligence phase, where are you primarily looking to enter? Do you wait for a base to form? Do you look to trade kind of the range off the bottom of the institutional due diligence phase? How do you generally kind of like to handle it?
The first thing I would say is the absolute very first time I would ever even consider trading it would be, it has to get above the 50-day moving average of the red line. Better yet, when it gets above the 200-day moving average. And in this case, notice how it got above the 200-day moving average on a daily chart and heavy volume that finally shows up here. And I do want to see like a rounding out of the bottom. Like it went a long time, hit a low, then went up and then lower, up, kind of back low, but not as low as before. Up, back low, again, not as low as before. A third time up, running into trouble. And again, a higher low. So I'm seeing a pattern of a little bit higher highs and higher lows. It's like, okay, they're trying to push it down and it can't. Oh, it got above the 50-day. Oh, it got above the 200-day. And then I'm looking for, where is it kind of consolidating? And if I look to the left, it's like, oh, that's a prior high. Wow, if we could be above this consolidation, that prior high, now it's really giving me confidence. Now it's time. And it did. And that was what gave me the confidence. It's like, okay, you're above the 50, you're above the 200, you're above the most recent high, you're above the high of many months ago. Now's the time.
Yeah, excellent. And you've got a buy one and buy two there. How do you generally like to split up your purchases if you're looking to build into a position?
Well, I look for buying half of my position up front. And then when it's up 2%, I buy more. In this case, I waited a little longer. It was up more than 2% here, I think. I don't remember why I didn't buy at the time, but I didn't. It came back down, and then when it finally got up to here near the round number 50, that's when I bought again. But yeah, I usually try to buy a little bit after an advance. And with a recent IPO, I try to just limit it to either buy once or buy twice, and that's it.
Yeah, excellent. And this one, of course, today is kind of when we're recording this is kind of you're seeing some weakness recently. How are you personally handling this? You've got a strong profit cushion. Are you kind of looking for it to form a new base here? What's kind of your mindset based on the recent action?
The recent action is twofold. One is I'm using the midterm rule
Mhm.
that we should talk about in our book. The midterm rule is kind of when you're in the institutional advanced phase, you're looking for 2 weekly closes below the 50-day moving average. Then you take the lower point of those 2 weeks, and then I go maybe 5 to 6% below that as my stop out of the stock. This is the second week where it's going to close below the 50-day moving average unless we get a miraculous recovery. Not shown in this chart is that today's action, which actually puts it down here even more.
Yeah.
And also, I started to hedge on this stock when they got the weakness in this area. I bought some puts so that it helps me sleep better at night and hopefully not incur as many losses. So what I'm doing here is I'm using the 52-week rule. I'm sorry, the midterm rule, and I'm also I've hedged.
Yeah, excellent. And just because you mentioned it, and maybe some people watching it aren't super familiar with it, could you point out the turbulent zone on this chart? Just kind of identify that. And it had a nice pullback kind of back towards that area, which is kind of cool.
Turbulent zone is this high here, which is right below $60. And you can see it kind of reaches that turbulence here and then pulls back, and then it bursts through. And it even still comes back and tests the top of the turbulent zone. From the top, it's testing it underneath, and then it took off again. Oh, look, even one more time, it came back to the turbulent zone. So that's kind of where the turbulent zone kind of kicks in.
Yeah, excellent. And then, based on, the recent themes that have been strong in the market, um, we have seen a few kind of semiconductor IPOs, ARM, as well as I think ALAB is one. But have you kind of been surprised that there haven't been more AI specific focused IPOs come to market? Obviously, maybe that's because, companies are kind of integrating AI versus starting whole new companies regarding that. But just wanted to kind of hear your thoughts and if that's something you're looking out for. A lot of IPOs kind of focused on that theme.
I think you made a great point. First, a lot of the big companies are going into AI, like Microsoft and Amazon and
Yep.
Apple. And so they're already out, right? They're the ones also spending the big bucks. There are smaller AI companies, but those are all really, some of them have just started right after ChatGPT started, and they're new, and many of them don't even have earnings yet. And so not many of them have come out public. I've seen a couple. ALAB is one. I've traded in and out of ALAB. So far, it has not been a profitable trade for me yet. I think it's more of the early stages, and maybe there will be some companies other than ALAB and some other smaller ones that have a better track record with being able to show sales growth
Hmm.
and maybe even earnings in AI before they come out. So I've noticed in the last 3 to 4 years, the IPO market has been more discerning and almost forcing companies to have real earnings or be real close to earnings yet if they're negative, and to have growing sales. That you can't be coming out right now as a public company if you're really in the early stages and you barely started to have sales. It's just not going to happen.
Yeah, and I've actually kind of uh, when I've talked to different traders, when they see a new IPO that comes to market in a weaker environment, even a bear market, when there's a little bit more scrutiny and you have to have the earnings and sales, that's actually maybe a stock to look out for and watch a little bit more closely. Is that something you subscribe to too? Kind of, focusing on the stocks that came out in kind of poorer and harder dollar environments, something like that.
Yeah, I agree with that.
Mhm.
If there's some stocks that come out during bear markets, and if they meet that test of you can come public during a bear market and they treat you well, that's a stronger company than normal, because most companies don't come public in a bad market. And I definitely want to see, like, it seems like the Wall Street in general, I do want to see, I have more confidence when you have real sales growth and real earnings.
Yeah. And that might be, 2020, 2021, it was just, that with the Fed, interest rates where it is, there was a lot more money available, kind of freely available. So with all the
If, if,
SPACs coming
if,
public,
if,
yeah.
if we made a list of all the companies that came public in 2020 and 2021 through both IPOs and through SPACs, I could show you chart after chart of stocks that went out and then straight
Disappointments.
down, or
Yep.
a little bit of an IPO advance and then a straight down. They were one-hit wonders with hardly much of a hit.
Yep. Yep. Well, perfect. Eric, this has been really fantastic. I think going through the charts here was really, really fascinating as well. Hopefully, everybody who's watching is enjoying this. Do you have any kind of last words of wisdom or advice for traders here? You shared a lot of great lessons at the very end, but any kind of last reminders for people to help improve their trading? If they're early on in their trading journeys, some encouragement. What would you kind of leave everybody with today?
Well, if you're early on in your trading, and especially if you're, let's say, under 40 years old, you have plenty of time. You can master this. It takes time. Don't be afraid, but spend the time. And you're going to make a lot of mistakes. Most traders, they're maybe only 30 to 40% of their trades make money at best. So you're going to may have more losers than winners, but you want to cut the losses short on the losers. Try to ride the winners for longer. Try to find sell rules. Don't trade emotionally. Don't think you're smarter than everyone else because you're so good at whatever other chosen field you work in. Because there's traders out there who've been doing this for years, and they're happy to take your money if you think you're going to be better than them. And don't give up, but try to not try to make money quickly. Try to build it up slowly and just get very good at it before you innovate.
Excellent. And yeah, there's a lot to learn from what you presented today. I know some people maybe, it was too quick going through the screens, but as Eric mentioned, the screens will be available. So we'll actually post a link just very shortly here where you can go ahead and get them for free. So I'd really encourage you guys to really study them, the screens especially, running through the charts as well. But with that, Eric, I just want to thank you one more time for being a part of the conference. We really appreciate it. And yeah, we'll be right back with our next presenter. Stay tuned.
Thank you, Richard. I appreciate the invite, and you guys do a great job over at TraderLion. And I highly encourage people to sample what they have on the website. And don't forget to buy the Masterclass IPO class if you haven't seen it yet.
Yep, excellent. And we'll be right back. Cheers.
Bye.
All right, welcome back, everybody. I'm excited to introduce our next speakers, Peter Robbins and Agnieszka Wood, both experienced traders, coaches, and teachers. They'll be presenting on empowering traders through strategy, alignment, and self-control. This is a topic that I've been really looking forward to. Peter and Agnieszka, thank you so much for being a part of this. Really looking forward to this presentation. I'll hand it over to you guys.
All right, thank you.
Thank you, Richard, so much. Again, we'd just like to thank you first for having us present at this year's conference. Very humbled to participate with such great traders and educators, many of whom have been mentors to us over the years. TraderLion Conference has always been a great resource for traders' education, and that I know I personally recommend highly to most of the traders that I encounter. And so much value offered for free, and hopefully some of that will be translated into donations provided to support the St. Jude's Children's Research Hospital, and that's fantastic, right? So just want to introduce myself a little bit first. I got interested in trading very early in life. My first account I opened at the age of 15. Yeah, that was a long time ago, and although things were very different then, the attraction to trading was still probably the same for me then as it is for most traders now, which is to make money, right? And at that time, it was a little different. Dealt directly with a broker. There was no online trading. Commissions were very high, no free trading, and execution was very slow. Trading has remained a passion for me, and I've evolved over the years as new technology has drastically changed the environment. As you mentioned, my interest is in trader psychology and performance enhancement, which I feel is a major barrier to trader success. Over the 40 plus years, I've traded many different trading styles, different instruments, from day trading S&P futures to longer term CAN SLIM style stock investing, with many different mentors that I've had. I am a retail trader who continues to learn and evolve and wanting to help others along that journey, right? And through Twitter or X, I have been fortunate to meet many traders from around the world. It's a really great community. And today I'm presenting with Agnieszka Wood, who I was lucky to have met a few years ago through Twitter. And we've been collaborating on some presentations like this. And actually we're working together on a book that we're working on together. So, and so before Agnieszka introduces herself, I just wanted to share this slide that really highlights sort of what drives our involvement with helping other traders from a trading psychology perspective. And that's really that, many traders focus primarily on the outer game of trading and spending 80 to literally 100% of their time around their strategy, right? What can I tweak in my strategy to become a better trader? Yet most of the barriers to their success are really based on the inner game. So they experience ongoing frustrations, but fail to focus where the real solution lies, right? And that's what we're going to be speaking about today. So, Agnieszka.
Well, thanks so much, Peter. It's always an honor and such a pleasure to work together with you. And hi, everyone. I am truly grateful to have this opportunity to present among the icons of our industry. And thank you, Richard, of course, for inviting us and for all your hard work to make this conference happen. And I have been attending all your previous conferences, and it's just so fantastic to see that so many traders gain so much value from this event every year. So thank you for that. And just a few words about what got me into trading. Just, like many traders, my journey was totally unplanned. When I graduated with a degree in marketing and management in 1998, I aimed for the corporate career. And starting even before I started college, I started working for a corporate office. And independence played really a big role in my life since early on. That's a totally different story, but fill a workshop with that. But I'm not going to do this today. So including financial freedom, that was part of the independence, of course. And after graduation, I emigrated from Poland to the Netherlands. And that's where I studied neuro-linguistic programming and learned about the potential that we have in our minds. And Tony Robbins was one of the big authorities in my life for that direction. And that really sparked my passion for personal growth even further and led to intensive development as a life coach and educator. And trading wasn't even on my radar at that time, but I was always exploring different ways to challenge myself and expand my limits. And it wasn't until 2010 when I met my husband and then boyfriend, and he introduced me to trading. I had a successful business and lots of savings at that time, so money wasn't an issue, but I really had no idea what I was getting into. And I thought that trading was simple. I looked at the charts. I thought buy low, sell high. And I was really too stubborn to listen to any advice that was out there, that trading wasn't that easy. And when I moved to the US in 2014, I decided to trade full-time. That just seemed like the perfect opportunity. I lived in Miami Beach at that time. It was just perfect. So I quit my well-paid job and just got into it. And the first 2 years were really rough. And I lost a lot of money. I compromised my health before I realized that trading was actually a little bit more complex than I thought. And to be where I am today, having the total freedom, what I do with my time, and making a comfortable living from it without stress and worries, I really had to go through major changes in my life. And looking back, I can easily say that my trading journey has been one of the most enriching experiences of my life. I never regret the pain, the effort, the lost money, because it helped me become not only a better trader and a better person, but it also allowed me to make a significant impact on the lives of others. Because for the past 5 years, through my coaching programs, I have successfully been able to help many traders to break free from their failing cycle and achieve consistent results. So I'm very, very proud and happy of that. And over the last 30 years, I have built a successful corporate career. I've been my own boss multiple times, made plenty of money, and faced many obstacles. But trading challenged me in ways that no other endeavor in my life did. Many times throughout the process, I thought that there was really something fundamentally wrong with me. And I know that many traders experience the very same thing, losing confidence in themselves with each mistake and questioning whether they will ever be able to make it. But I want you to know that there is nothing wrong with you. And it often might feel that way, but you need to realize that trading is not like any other job. And if you are like me and most retail traders, when you started, you might have not realized what it really takes to become a successful trader. And growing up, you maybe didn't have anyone in your environment who was a trader or who was investing or even was a good example of good money management. So you might have come into trading completely cold turkey. And I think it's really important to acknowledge that and also realize that the environment that you are operating in is completely different from what you are used to. Most of us are not accustomed to the conditions that we are exposing ourselves to. And even if you hear from others, what trading is, it's just not the same as fully accepting the reality of the conditions you are choosing to work in and adapting to it. And let's call it your working conditions. So what are those working conditions? As a trader, you are working in an uncertain environment. You don't control the market. You don't know what's going to happen next, which means that you cannot expect everything to work out according to the plan. And in fact, most things won't. And the results from yesterday do not guarantee the same results today. Even if the setup is the same, and even if you feel as confident as yesterday, you cannot base your future results on past results. And that applies not only to positive results, but also to losses. Losing is as probable as winning. Big part of your efforts, which can be the most frustrating part, will not give you the results you want. In the market, the rule of working more and making more does not apply. You have to be prepared that at least 50% of your efforts will not bring you money. So basically, nothing is certain and everything is possible. In these working conditions, you have to make decisions that involve the possibility of losing your hard-earned money. And these decisions will affect not only your well-being, but also the well-being of your closest ones. And that's a lot of pressure. Not to mention that many of you are trading time, which even adds more stress to the equation. And to survive and thrive over extended periods as a trader, you need to ensure that you're not only able to make money in these working conditions, but more importantly, you are able to keep it. This is exactly where the inner and outer game come into play.
Thanks,
Peter?
Agnieszka. Yeah, thank you. So today, the presentation we've put together, we've got a number of topics that we want to cover. We're going to talk about some critical components that are both within the inner and outer games, right? So your trading edge includes components from both. For the outer game, we're going to focus on the importance of ensuring that you and your outer game are aligned. And then many traders just jump into trading with little thought to how the strategy that they have chosen fits their unique personality, their experiences, and their goals, right? This creates an initial barrier to them being able to tackle their inner game more effectively. So we will also offer some suggestions on developing your inner game with tips and tools to help you in that process. And then finally, we present ways to track and monitor your progress to better evaluate and appreciate your trading maturity and evolution. So I want to start off with, again, what is the outer game? So the outer game focus on the technical aspects of your trading plan and the tools that you use. It includes what you trade and how you trade, the market analysis you do, your entry and exit plans, your money management rules. So it's all about developing a well-defined trading plan. Like to use an analogy, sort of if you're thinking about sports, right, where the outer game is the physical training you would do, the techniques you use, and your playing strategy. But before you can even begin to develop your trading plan, ideally you want to make sure the trading strategy you decide to follow fits your personality, your risk tolerance, and your lifestyle. And this is what we mean by being aligned with your strategy. So strategy alignment. What is your relationship with your strategy? And are you fully aligned? Like I said, many new traders ignore this step completely. We all know trading has a very low barrier to entry. Anyone with a few bucks and a computer or a cell phone can be in the business almost immediately, right? Social media promoting trading as an easy, surefire way to financial freedom, has many traders jumping in with little knowledge or experience. Even many experienced traders have not fully evaluated which approach best fits their situation or are struggling. So as I mentioned, many traders are struggling because they do not focus on the inner game issues, but often these issues are so much easier to address if you start with the proper alignment with your outer game. Often they also become fair weather friends, going from one strategy to another, never giving them a chance to develop their outer game skills. I know myself, I've always suggested new traders to study numerous trading approaches and styles to initially understand all the many ways that you can trade. One of the books that I always recommend is the Market Wizard series, which is a really great resource for this. Great exposure to many different styles and approaches. And in continuing with the sport analogy, this step is like trying to determine which sport do you want to play. Your edge and level of success will depend on how well that fit is. When you think about someone, kids wanting to learn, do I learn basketball? Do I learn volleyball? Do I learn tennis? Each different sport would appeal to different people and different skill sets they have and characteristics. So for trading, again, there are a number of points to consider when looking at the strategy you want to use, right? So how much capital do you have? How much risk are you comfortable with? What are your return expectations? Are you a fast-paced or slow-paced decision maker? What experience and knowledge do you have or willing to learn? Are you interested in fundamental analysis or technical analysis? What instruments do you want to trade? How much time do you have available to trade? I know Agnieszka, me and you, we meet many traders. They're just automatically become day traders because that's all you hear about on the internet or on social media, right? So they jump into day trading. Meanwhile, they have jobs. I don't know when they're day trading, but it seems to be the go-to, which often is probably the most stressful and most difficult type of trading that you can get into initially. So anyway, again, when you think about it, there's so many different types of trading: scalping, day trading, swing trading, trend trading, all the different instruments that you can trade, stocks, whether small cap stocks, large cap stocks, options, Forex, crypto, futures, different trading approaches, like I say, fundamental analysis, technical analysis, and styles, whether you're a value investor, growth investor, momentum trader. So there's just so many things to consider before choosing the approach that you want to do. And like I say, a lot of people, they just jump into something and don't even evaluate that as a fit. So committing to your strategy. So again, the key is to go through those things, really think about it and identify. And a lot of times something will, as you're studying, you'll see things that are appeal to you and fit to your personality. But once you do find a strategy, we just want to make the point about how it is you need to commit to that strategy for some period of time. Trading is a serious business. It's not something that you just jump into. Acquiring any new skill has a learning curve, and trading is no exception to that, right? So it requires serious study, dedication, and experience to master. Unlike, what you might see on the internet where, 24 hours you can learn how to be a day trader. Must have realistic expectations on the performance so that you're not easily discouraged. You can imagine if people read like, oh, you can make 100% return on your investment in 2 months, and they're struggling to break even or losing money. It's easy. Okay, that strategy is not for me, right? I need to switch to something else. So continuously switching approaches, you never get past that critical learning phase. I'm just going to mention that, many attending this conference as an example will be exposed to numerous strategies and approaches, right? So if you're tempted to totally change your approach or are new to trading and find one of interest, just make sure that you're choosing it or switching for the right reasons, right? Because you feel you're better suited, not because you have dedicated yourself completely to your current approach and giving yourself a fair chance to succeed, right? So aligning with your strategy does not mean you're done and everything is going to always work out well for you. The market will continuously challenge you and trigger you. So you need to build emotional resilience and understand the dynamics behind your behavior so that you can control it. The better aligned you are and the less barriers you come across on your journey. And that's where the inner game becomes important to address, right? So again, what I've tried to cover here is that so many different ways strategies to choose from, so many things to consider. Don't just jump into it. And if you are in something that you're not comfortable, you don't feel comfortable with, do that analysis, pick something well, give yourself a chance to really learn it and a time to do that. Recognizing that even with all of that, that's just, again, that's that 20% we were talking about. The 80% of the issues you need to address are really going to be around the inner game. And that's where we'll go to next. Thanks.
That's almost like we were talking about earlier. It's like choosing your relationship, right, Peter?
Yeah.
It's like the difference between dating or really choosing a relationship long term. So you can kind of get the feel for, switching your approach or really going for something and putting your effort into it. So inner game, let's talk about the inner game. Not many traders realize really what the inner game actually means. And it usually gets associated with discipline and controlling emotions, right? However, it is really about your mental conditioning and developing your emotional immunity. It's about how you deal with the input that you get from the market the information and everything that's happening in front of you, you know, the price action, all the running stocks and everything that's just right there in your face. And how you manage the mental processes inside while all this input is getting in, what is happening inside your head that you can produce the desired output. And this means coming up with responses that are in your best interest instead of reacting emotionally. So it is not just about understanding that fear, greed, and all other emotions can cloud your judgment and lead to poor trading decisions, but also realizing that you are in fact predisposed from the outset to make poor trading decisions. You see, the most of our mental conditioning that works in our everyday life just does not serve us well in trading. The market triggers you in ways that activate your natural defense mechanism, the fight or flight response, causing you to act against your best trading interest. So if you want to succeed in the market, you really have to become aware of that. When these processes are taking place, how they work, and how they affect you. And this awareness allows you to learn to stop them and change the course of events before the damage occurs. And the goal of developing the inner game is to adjust your current conditioning and to make it compatible with the market environment so that you can stay calm, focused, and objective during trades instead of making decisions based on fears and beliefs that are not in line with market dynamics and your own trading goals. And today I'm going to show you how you can do that. So here are 3 steps that will guide you through this process and help you develop your inner game. So the first step is building awareness. It might sound like not much work, but it's really profound. This involves recognizing how you are being triggered and what automatic responses are activated by those triggers. The second step is discovering your narrative, which is about identifying the beliefs that fuel your automatic responses. Essentially, discovering what your current mental conditioning is, and then shifting your mindset. This third step involves changing your beliefs, basically the story that you tell yourself and the thoughts that drive your self-sabotaging actions. And by doing this, you can change the patterns of your reactions. If you put it in simple terms, shifting your mindset is really about shifting your focus from one point of attention to a new one. And it means moving from thoughts that are detrimental to your trading to thoughts that promote actions in your best interest in trading. However, to do this, you need to first understand what those detrimental thoughts are and how they currently influence your trading decisions. This is the same process that I personally guide my clients through in my coaching programs, and you can go through it on your own, but it's simply easier and quicker to achieve results when someone points you in the right direction. Years ago, I went to South Africa and visited Paul Kruger National Park, and I was so excited for the big 5-game drive to see the lion, the leopard, black rhino, the African bush elephant, and African buffalo. And the first 2 days, I drove myself around for hours and saw only a few impalas, essentially lion food, and they were everywhere. That was it. And it was just so hard for me to believe that I couldn't spot any other animals in one of the Africa's largest game reserves, covering 7,500 square miles. It was beautiful, but I wanted to see the big 5. And they know how to hide, blending completely into the environment. Can you actually see them on the pictures? I'm curious, what animals can you see? Let me know in the chat. So then I took a guided tour and a completely new world opened up to me. And I realized that if you don't know what to look for, you can miss what you're searching for entirely. You can spend hours and days, waste your energy, and walk away with nothing. So here they are. I know the giraffe was kind of easy, just to warm you up. I can tell you that having someone who can show you what to look for makes all the difference. So let's talk about building awareness, because you cannot change what you are not aware of. And building awareness is about discovering how the market triggers you when you are trading and what exactly it triggers inside. Another crucial aspect of building awareness is learning to recognize where your attention is focused. Becoming aware of where you place your attention allows you to intentionally direct it towards thoughts that serve your best interest, especially when you're trading. Nowadays, there's so much stimulation around that most people have their attention totally scattered. In trading, many people ruminate about past losses or dream about future gains. And recognizing where your thoughts are in the moment and redirecting your focus can change the course of your events, meaning the events that the response to the trigger. So let's do a small exercise. If it feels, if it's okay for you, just close your eyes for a moment and take a deep breath in. And as you exhale, bring your attention to the air coming out of your nostrils. And do this a few times, in and out, and focus on the temperature, the strength of the air, maybe a smell, or what is it that you experience. And now bring your attention to your thoughts and notice what is passing through your mind. Now open your eyes and look at the candle flame on your screen. Focus on your attention on what you see, just on the candle. And now shift your attention back to your thoughts while looking at the candle. Now look at something else in your room and focus on that object. And finally, bring your attention back to your thoughts. Great. Let me know in a chat how it went. Was it easy to switch for you? Did you notice the difference between focusing outward and inward? If this was challenging, it's because our mind often takes over, directing our attention to the loudest point of attraction. And learning to intentionally point your attention and switch focus helps you observe your mind without getting caught up in your thoughts, which, as you might know, can make you really emotional, especially when you trade. So when you can choose your focus with purpose, you can actually choose the thoughts that serve you best. And this also helps you become an observer of your thoughts, allowing you to stand aside rather than be swayed by passing thoughts and emotions. It gives you control to decide whether to engage in an emotion or let it pass. And as you saw, it's quite easy to practice that. And eventually you can develop unconditional internal balance, maintaining mental calmness and composure, regardless of external circumstances. And in trading, external circumstances can undoubtedly make you emotional and lead to poor trading decisions. The market often triggers your automatic stress responses, and you just act accordingly. Basically, what happens is when the trigger fires off, such as losing money on a trade, you react based on automatic program. You don't want to lose, so you just try to make your money back and start revenge trading. Easy, right? Very logical. If you are unaware of this program that's operating on a subconscious level, you just simply follow it. This reaction repeats over and over like a programmed machine. So can you change that? Yes. But truly the more important question is how? And we all know you cannot change the market. The market is what it is. It will always fire off triggers and we have no control over it. But you can change your reactions to what is being triggered inside you. So you can stop reacting out of your automatic programming. And to change your reactions, we need to look at what happens between the trigger and your response, because there is a process that's very quick and occurs based on your subconscious program. So most people are unaware of it. However, it influences your reactions and consequently your trading decisions. So becoming aware of the program is really the first step. But yeah, what exactly should you pay attention to, you may ask, right? Start noticing the thoughts that pop up immediately after a trigger is fired. Pay particular attention to the thoughts that keep coming back, those repetitive thoughts, because they are the code of the program that you are running. And these thoughts represent your beliefs. And we have many beliefs, some stronger than others, and we develop them throughout our lives. And in fact, any thought has the potential to become a new belief if we repeat it often enough and find enough evidence to convince ourselves it's true, even if it isn't. And regardless of whether the belief is true or not, we often identify with some of them so strongly that we consider them the truth. And we completely forget that the belief was once just a thought we started to think. So the beliefs we are particularly interested in are the limiting ones. You might have limiting beliefs and not even realize it because they just seem like the truth to you. And limiting, or you can also call them sabotaging beliefs, are simply thoughts that guide you to act in ways that may not be in your best interest or prevent you from doing something that is in your best interest. For example, if you believe you must work hard to succeed, it might be quite difficult for you to stay away from trading when things aren't going very well that day. Or you might force trades even when there are no good opportunities. And you might feel like you want to control the market because you believe that success is in your hands. And as long as you put in enough effort, you are going to succeed. So it is absolutely key to learn what beliefs you have that are feeding the stories you are telling yourself about you as a trader, you as a person, the market, achieving success, money, etc. As Orson Scott Card said, we question all of our beliefs except for the ones we really believe in, and those we never think to question. And that brings us to the second step, which involves discovering your inner dialogue, the narrative, so you can understand how you possibly limit yourself. It's about where you put your attention and what you're focusing on. What are you telling yourself every day, every moment, and especially when you trade? What do you say about yourself as a trader, your trading decisions, your success? In this step, you will uncover many limiting beliefs, I promise. And once you identify how your narrative limits you, so what those limiting thoughts are, you can then work on stopping them from holding you back. It's pretty simple, actually. And here is how your narrative impacts your behavior. So after the triggered event fires off a thought, before you react, an emotion comes up. And how you feel is based on the thought you just had. So by the belief that is associated with what just happened, that's how you're going to feel, and you then act based on that feeling. And so when you keep telling yourself you are a loser after taking a loss, which is, by the way, a very strong limiting belief about yourself, or you are questioning whether you will ever make it as a trader, you might simply feel fearful, insecure, and that will influence your next trading decision. And if you keep telling yourself that you simply cannot lose more money because you have already lost so much, you will obviously try to do everything to protect yourself from losing, which means overtrading, oversizing, and generally increasing risk. And this dynamic can result in cutting your profits short when you are in a winning trade or staying in a losing trade for too long. So you see how important it is to identify your limiting beliefs. And feel free to take a screenshot of this slide so you can do this later. But one way to discover your limiting beliefs is to take a behavior that is sabotaging you in trading, so that makes you act against your best interests, such as oversizing, removing, or not even placing a stop or a loss order, and exposing yourself to unnecessary risk, and asking yourself, what do I have to believe in order to act that way. And once you discovered your limiting beliefs, the stories you tell yourself that cause sabotage in trading behavior, that's when you can begin changing your responses to triggers. And just remember that what you really want to focus on in this process is on changing the beliefs and thinking habits that are connected to those triggers and not changing your response, because that's just a symptom of that belief on the underlying root cause of your struggle. And that's the final step of developing your inner game, the mindset shift. And it involves shifting your focus away from limiting narrative towards thoughts and stories that empower you and serve your best interest. So in this step, you focus on intentionally choosing the thoughts that are needed for you to achieve the results you want. And you have learned that in the first step. And when you do this often enough, just like with your current beliefs, your new thoughts will become your new beliefs. And this way you can replace any limiting belief with an empowering one. And with your new beliefs, you can then direct yourself towards the responses that support your trading goals. And if you think right now, that's a great process, but I don't believe this will work for me. I've tried so many things already and nothing worked. Just be aware that this might be your limiting belief speaking. So I invite you to at least give it a try and begin developing your mental awareness and discovering your narrative, because this will help you identify what is limiting you and starting the process of shifting towards a completely new mindset. Just imagine for a second the freedom, the control, and the empowerment that you will feel when you can finally choose your responses instead of just reacting. I really hope you are excited and you want to give it a try. So changing your limiting beliefs is really just one part of shifting the mindset. If you want to succeed in trading, just like in any other challenging endeavor, you need to take responsibility for the outcomes. And that means that you cannot blame anyone or anything for your losses. It's not that the market is stupid or someone did something, the guy on Twitter told that this will go up. If you don't believe that you are responsible for the results of your actions, how can you even change the results? So as you build your awareness and you will begin to recognize when you are avoiding taking the responsibility. For instance, when you enter a trade without a plan and say to yourself, let's see what happens. That's actually a sign you are actually avoiding responsibility. Make no promises that you cannot keep. This is about personal integrity. Every time you say you will follow your plan and you don't, you break a promise to yourself. And that simply diminishes your self-trust. Why should you believe in yourself if you never keep your word? You wouldn't do it with any other person, right? You would just give them the first time the benefit of the doubt, but then after that, you wouldn't be so certain that they will keep their word, right? So ensure that your goals and expectations are realistic so that you can actually make promises that you can keep. And this is the beginning of showing yourself that you are capable of doing the right thing. Focus on small steps because it will be much easier to follow through and it will help you build self-confidence. You need to start building evidence for yourself to show you that your newly formed beliefs are true. This way, they will become your new program. And then at some point, you don't really have to even think about doing the right thing. You will just do it. Shift your focus to what will help you achieve your objectives. So concentrate on the process and making progress rather than getting hung up on your mistakes. Learn from your mistakes, take them as feedback, and move on. And also look beyond your trading. Ensure that you're taking care of yourself and your overall well-being, because remember, the trading environment puts you under high pressure and you cannot underestimate it. And you need a healthy outlet outside of trading to simply rebalance your nervous system. Control your thoughts to control your emotion. That's a very important part, because when you focus on the present moment, instead of dwelling on past mistakes or worrying about future scenarios that might never happen, that allows you to control your emotions. Pay attention to stories that you tell yourself and how you speak to yourself. And treating yourself as your best friend would be a good start. So here is a quick way to begin changing your internal dialogue and shifting your mindset immediately. And feel free to make a screenshot of this slide so you can maybe make post-its later on and you can have it in front of you when you trade. Keep an attitude of curiosity, because this will help you stay unbiased about the market and takes a lot of frustrations away, I promise. Stop judging yourself. Give yourself some grace. Trading is very challenging, period. So have some compassion for yourself. Focus on the process, not the outcome. And I like to say, I know that everyone wants to make money, but you cannot make the money the reason for your effort. Remember that the money is the result of your efforts. So put the effort into the process. And this will help you avoid making emotional decisions. Use could have in your internal dialogue instead of should have, because this will help you stop ruminating about the past and move on. Because, you know, all of us really, we are all geniuses after the fact, right? If I knew I fell, I would sit down. So should have really does not have any sense, doesn't make any sense. And stop thinking, oh, I'll try. Just think I'll do it. Remember that everything you say, your subconscious listens and executes the program. So start rewriting your program. And last but not least, just stop asking yourself question why after every mistake. Why did I do that? You know why you did it. You know what? You know why you did this silly thing again. You just wanted to make money, or you didn't want to lose again. The more important question is how you did it. Because the moment that you begin asking yourself the how question, then you start building awareness and you can change things. I also have another tool for you that you can use to develop your awareness of where you are with your emotions during your trading day, so that you can stop yourself in time and come back to the neutral and confident zone before it's too late. You know how quickly things can spiral, right? And of course, in the ideal world, you would always want to be in the green zone. But as we have mentioned earlier, the market, we will just simply always trigger you. And the key is to become aware of when you begin to feel either invincible or desperate, so that you can then correct the course. So in the tool, you will find worksheets where you can mark up where you are on the scale, whether you will find yourself becoming greedy and feeling like nothing can hurt you, you know it all, or you start feeling like a loser where nothing is working out for you. And then when you start putting actually too much risk on because you feel that you don't even care anymore how much you lose. Ever felt that? I know I did. And then you will find the set of simple and easy to execute strategies in there. So that will help you to get back on track to the neutral zone in no time. And you can get it for free by scanning the QR code here or by clicking on the link in the chat. And just remember, taking action is key. So none of these tools will work unless you use them. But when you do, you can finally begin to make steps forward. And Peter is now going to talk about how you can measure if you are actually making progress.
All right. Thanks, Agnieszka. That was really great. And like I say, when I talk to so many traders and I look at this, one of the biggest limiting beliefs is that people don't believe that the inner game is what's really critical, right? So they're focusing on what new indicator should I add, all the other things, looking for the Holy Grail, but the Holy Grail really is, it's you against the market, and you got to focus on yourself, right? And this is again just a reminder, review of what you said right before, working on your inner game. Many traders are stuck in this endless cycle of bad behavior, right? And they're breaking their rules, they're over trading, revenge trading, they're trading on tips or trying to take advice from other people on the internet. They're trading based on FOMO, listening to the latest fad or latest story, and I think that's how they're going to make their money. Jumping into random trades, not following their plans. They remove their stops. Again, that's a very common one, right? The biggest thing of why traders blow up their accounts is because they don't limit the risk, they don't have a good money management strategy, and they're, again, for some reason, that behavior is some belief, something is driving them to think that they're right, and they're willing to remove those stops and take that extra risk. Adding to losing positions, increasing their size, chasing entries, etc. Right? So again, like I said, these are behaviors are really symptoms of deeper underlying issues that need to be addressed by working on your inner game. And like you say, going through that 3-step process is a great way to do it. That truly is sort of the Holy Grail. And again, we've provided a number of tools for that. I guess, so now assuming you've done this, you're really starting to work on your inner game, right? So it's important that you monitor your progress, because you're going to be continuously sort of coming back. And, again, it's not a one and done, right? This is something, it's an ongoing exercise that you need to do. So you can evaluate how effectively you manage your emotions, such as your fear, greed, frustration, impatience, by keeping track of whether a trade was based on impulsive trading decisions driven by your emotions, or are you following your plan, right? So keep track of that. Again, whether that's a journal, whether that's, tracking all of your trades. You can also measure emotional volatility during a trading day using a tool like Agnieszka shared, right? So make it a conscious effort to do that, right? Don't just at the end of the day saying, oh man, I don't know what happened there. So keep track of it, right? You can track your ability to stay calm under pressure. So when you're in a trade, make notes on your bodily sensations, such as how are you breathing, your heartbeat, sweaty hands. Again, this is that thing of awareness, that first step, right? Really be aware and continue to be aware as you're trading so that you can monitor these things. You can measure your psychological resilience in coping with losses, setbacks, and periods of market volatility. For instance, how long does it take to recover after a loss? Emotionally, right? So how soon do you stop feeling miserable and just thinking about it all the time, versus being able to say, that was a loss, I learned something from that, I'm not going to do that again, or I've learned my lesson. You can also keep score of how confident you feel during challenging times, right? You can even scale yourself on that. The key, again, is to continue to improve your awareness, track progress, continuing to identify your areas of weakness, and then develop action plans to address those, right? And the goal ultimately is to become, the trading journey is a journey of continuous improvement with a goal to become what we'll call an empowered trader, right? So what does it look like? So we've broken down 5 different categories here. So emotional control, better emotional control. So you have reduced fear and greed. You feel calmer during trades, less prone to panic selling or revenge trading. You're more acceptance of your losses. You view losses as a learning experience, not as devastating setbacks. You'll have a more disciplined approach. So you're sticking to your trading plan. Again, I don't know how many times most of the people that contact me, it's all about, oh, I broke my rules, I broke my rules, I broke my rules. Some of them don't even have rules, but those that do, often it's just, they don't follow the rules. So following your predetermined strategy even when emotions might urge you to deviate. You have improved risk management. You're no longer, you can manage your risk effectively. You're not overexposing your capital on single trades. Again, it comes down to you've got a money management strategy and you stick to it. Overall, your trading performance should be improving as well, right? So you've reduced trading frequency, you're less impulsive, you're focused on high quality setups. And then ideally you have improved win rates, less volatility in your equity curve, and then overall more profitability. And you know, you want your equity curve to be going from the bottom left to the top right all the time with less volatility. Improve mental clarity. So again, this whole thing of focus and attention, right? So you maintain focus during your trading sessions, avoiding distractions, emotional noise, and you're aware when these things are happening, when you're liable to be, you know, influenced by that. And then you have more objective analysis. You analyze the market movements and chart signals objectively with less influence of your biases and these emotional impacts that are making your behavior bad. And then finally, overall, your mindset is better. You have increased confidence. You trade with a sense of calm, confidence, knowing you're prepared well. You're learning from your mistakes. Again, that thing of your mistakes are an opportunity to improve your strategy and avoid repeating them. And then finally, you hopefully enjoy the process. You find that the process of trading analysis stimulating and challenging, not stressful, and you're actually, you know, having fun with the market, not feeling like you're in a continuous battle with it. So the next steps, we just want to go through the different takeaways from this presentation. First thing, the market operates in a totally different way than most of us are used to. And the solutions we are using in our daily life to solve problems and to achieve success are not compatible with the market environment. It's not only that they don't work, but in most cases they work against you, as Agnieszka said, like, for example, trying to trade more when you should be walking away, or looking for certainty and trying to be right while you have no control over the outcomes. Next takeaway, to survive and thrive in this unpredictable and constantly changing environment, you need to develop your edge as a trader, meaning find the way that will allow you to perform in these conditions. And that includes developing both your inner and outer game components that we talked about. As for the outer game, the alignment to your strategy is critical, but that's not enough. That's just part of the game.
And to be able to successfully operate in the market, you really have to operate in the way that it's compatible with it, as Peter said. And that's the inner game that most traders ignore to address, unfortunately. And most just trying to solve their issues by using coping mechanism, and those only work short term. I have so many people coming to me and they say, I tried meditation and breathing and it just doesn't work for me. If you use it as a coping mechanism, it won't. Your symptoms will come back. So if you are really serious about your trading success and you want to thrive as a trader, then you have to start thinking long term. And that means start addressing the root cause of your struggle and shifting your mindset to be able to operate in the market successfully. And a lot of people struggle to do that on their own. You know, it's just not easy to know how to do it and who to ask for help. There's so much out there, right? Like it's hard to figure out what's the best way. And there are a lot of traders also that are already successful, that are willing to help, that you might think, okay, this guy is just too successful to ask for help. But look, this conference is actually the best example of that. People do want to share their knowledge and help you. And the process I showed you today is addressing the root cause so you can break free from the fading cycle for good. And so that there is a lot of tools that can actually help you. And sometimes you just need to ask for help.
So like Agnieszka says, there's tons of material out there, tons of resources. When I think back to when I started trading, there was a handful of books to look at. Now you can literally spend your whole life and then many lifetimes just reviewing material and trying to figure out what is. We've put together here is just, again, focus on books only, just a handful of books that we really highly recommend. I've mentioned before with the Market Wizard series is a great way to see various strategies, and one that is a great one to look at. I always recommend How to Make Money in Stocks by William O'Neill. It's a complete approach covering both technical and fundamental analysis, and actually the principles can be used for any sort of time frame trading as well. And then I had a Trading Chaos here. This was a big book that I read, or was a big influence on me when I first read it, when it was first published a long time ago. Really resonated with me, and that's what I mean by finding something that resonates, and then all of a sudden it's like, okay, I'm committed to this and I'm willing to learn it, right? And a lot of people just jumping in is not the way to go. Find something that resonates first. And again, with Bill, I was lucky. He was a mentor of mine. I had the opportunity to train with him in person and really develop that skill set. And then so those are sort of books around the outer game of trading, and then there are also some great books specifically on the inner game of trading and money specifically. And we've included the Daily Trading Codes by Brett. I know Brett's one of our mentors and has lots of great material out there. And then the Psychology of Money book, we've put that one there. But they're also, just in general, when you're talking about the inner game of trading, there's lots of books out there that are about the inner game of life, right? So really the inner game is really about dealing with yourself, dealing with your personal issues, dealing with your behavior, whether it's discipline, commitment, integrity, all of these things, all sorts of great material out there that's not necessarily specific to trading, but that you can apply to your trading journey for sure. I've included a few here that I really like. The Artist's Journey by Stephen. All of his books are great. The Archer, The Power of Now, Living Untethered. Again, these are just some sort of non-trading trading books, I like to call them, but really about, improving your inner life, and again, how it applies to trading is how you apply it. So.
Yes, and these days it's so easy just to switch on the audiobook, right? It goes much faster. So I don't have time to read is no more an excuse. And of course, one more book that's very important, your trading journal. This is like the best book that you can learn from, because it contains all your personal experiences, successes, your mistakes. So writing down your thoughts, emotions, and decisions that you are making during trades really builds your self-awareness, and it helps you manage your mental state. So this book holds you accountable and provides a clear record of your progress over time. So when you regularly review your journal, then you can actually identify patterns in your behavior and trading strategies, and that will help you understand what works and what doesn't, and it will allow you to make informed adjustments. So make it a habit, first of all, to write your journal after every trading session, noting key details like market conditions, your strategy, your emotional states, all your thoughts, and the reason why you're making certain decisions, and then to read it.
So Agnieszka, I just want to make one other point there. If there's one takeaway from this presentation too, and if you've got a limiting belief that you feel writing a trading journal is just, not for me, or it's not effective, I think we would challenge you, just try it for a few days and just see how powerful it truly is. Just make that commitment, and again, it will be something that you will reference, and if you continue writing it, it'll have a huge impact on your trading for sure. Sorry.
Absolutely. No, that's fantastic. That's great. And remember that the best insights often come from your own experience. And as Joe Dispenza said, knowledge is power, but knowledge about yourself is self-empowerment. And the last tool that I can give you, that we can bring over to you, is if you are really more interested in going through those 3 steps and want more personal guidance on that process to develop inner game, I have put together a series of emails with specific tips on how to implement them. It's 2 weeks long, so you get every day specific tips on how to go through that process, and it's completely free. So click on the link in the chat or scan the QR code, register, and you will get your first tip right away into your inbox. And remember that trading is a journey, like any journey, and it comes with its own set of challenges and learning experiences. So just don't be hard on yourself. It's really natural to face setbacks and obstacles, but these are really opportunities for growth and improvement. And if you need support, remember that you are not alone. Look at all these people who came here into this conference trying to help you. And here are our contact details. So please feel free to reach out if you have any questions or need guidance. And Peter and I would like to thank you for your time and attention today. And we really hope that you found this session valuable and that it just inspired you to take positive steps in your trading journey. Wishing you all the best in your trading endeavors and beyond. And now we would be happy to answer any questions that you might have.
Perfect. Well, first of all, thank you both for taking the time to put that together. I definitely appreciate it. I think everybody watching does as well. I've got some questions that I definitely want to cover, but let us know your questions over in the chat as we go. To start with, I actually wanted to bring it back to the trading journal, which you guys kind of was one of your last key points. I'd love to hear a little bit more about the details of what you guys ask yourself each day about how you traded. What are kind of the key questions that you ask yourself? What kind of tidbits about the market do you track? And just a little bit more detail about how you guys actually construct your trading journal, and any advice for people out there if they're kind of just starting to create their own, which I think is a really good challenge for everybody watching. If you don't keep a trading journal, try it for the next few weeks and see if it helps you. But I'd love to hear the details about how you both put that together.
Yeah, I don't know, Agnieszka, do you want me to go first here?
Go first. Talk about your journal, then I'll talk about mine.
Yeah, well, first of all, I just want to make a point. When people talk about journaling, it means many different things, right? So I think the first thing is to really understand what journaling is, right? So I think what we're more speaking about is more of the inner game type of journaling. There's also an outer game part of journaling, right? So as far as the outer game, when you think about tracking your trades and having the statistics and analytics behind your trading so that you can go back and continuously review that and get information. And even when people are tracking their trades in that type of journal, it's also important often to say, what type of setup was it? What was the environment like at the time? So oftentimes it's good to sort of classify your trades into different setup types or different market environments so that, try to codify it a little bit so that it makes data analytics after the fact easier to do, right? So that's one thing. I think part of what we're talking about more is sort of what a lot of people would think is sort of the, the psychological things, right? What do you capture there? And again, there's a couple of different approaches. One is they call just a stream of consciousness writing, right? Often this is recommended in the morning when people wake up to really just do a brain dump, right? So just try to get out whatever's on your mind, and it can just be, anything. And a lot of people find that just clearing their head of those things is a great way to, start fresh, right? And it's also, I would make the point of do this for a week or commit to that for a week. And what you initially start to write versus what you eventually start to write becomes very deep and very different, right? And I think this is the thing that most traders, most people in general, they go through life without really spending the time of thinking about their thinking, right? And thinking about what their beliefs are and thinking about, and these things, again, it's easy just to coast through life without doing that. If you start to write things down, and again, I would recommend writing as opposed to typing it, it makes a difference as well. But when you start writing and really starting to bring some of these questions, so you ask, what do you ask yourself, right? So you can start to ask yourself those questions too, right? Like, what did I do yesterday? Why did I do that? What's the belief behind that? And started to dig deeper, right? And you'll find, it'll be amazing. You'll find it anyway. Try it. You'll see it's amazing. I always joke about, the market is the greatest analyst that it's the cheap, not necessarily the cheapest analyst, because a lot of people pay high prices for that psychoanalysis. But if you take the time and you act as that go-between and take those thoughts and beliefs and your experiences and put it to pen and paper, you'll find some real deep revelations. And so that's my comments. Agnieszka, what about you?
Yeah, I think that there's one more thing to journaling, which I personally do while I'm actually trading, is slowing down, because your thoughts are going really fast. You have like 48 thoughts a minute, so that's really a lot of thoughts. And when you start writing while you are about to make your trading decisions, like if you are, let's say you are in a trade, right, and you have a plan and you have your exit strategy, and now the thoughts are coming, and that's not the right moment to start rethinking your strategy on the trade, because most likely you will talk yourself out of it or scare yourself out of it. And or you'll just simply tell yourself, oh, it might go higher than my target, and then become greedy. So I start writing the thoughts that I have when I'm in the trade, when I'm before the trade. I'm just trying to slow down my thinking process, because I can write as fast as my thoughts go. And sometimes, when people say, I don't like writing, well, then start recording yourself, because you also cannot speak as fast as your thoughts. So this will at least slow down the process, and it will give you really a good view of how I'm talking myself out of my plan. I think that's like the biggest thing for me is, what is my head doing while I had a plan, I already thought about this trade before I made a plan, and now how am I getting myself out of that original plan? Because, if you struggle with sticking to the plan, somehow you do that. And by writing your thoughts, how you are doing that will really give you insight. So then you can change that. So writing the thoughts, basically what's in there.
Well, that's really great. It opens up another whole thing about people thinking that they're experienced enough and knowledgeable enough to rely on their gut. So a lot of times they don't have that experience, and their gut is just their beliefs and their thoughts convincing them that their plan is not good enough and it's time to get out and it's time to make changes. But anyway, that's a whole other discussion topic. But again, oftentimes challenge. Every time you're going to either press that buy button or that sell button, take that moment to be aware and really understand why you're making those decisions and make sure that it's valid. So,
and once you get out of the trade and let's say it didn't work or it did work well, you can also make the notes of like, what did I see in the market? Or if you don't follow the plan, you get out. And even if you make profit, because a lot of times when you make profit, you're like, oh, this was good anyway, I don't have to write anything. Well, why did you get out too early, right? How did you talk yourself out to? Because that's better when you get out and then you see that's going to your target.
So I just want to make one other comment about journaling, because you asked, what do you do? And another important one I find is go back to your trades a week, depending on what time frame you trade. But let's say you're a day trader, look maybe in a couple of weeks. But if you're a longer term trader, obviously look longer. But really look at the chart, look at when you got in, look when you got out, look what it would have happened if you had, and it gives you input on maybe changing your rules. But where you broke your rule and you saw that if I had stuck with my rules, it would have been so much better. It's a great way to reinforce that message, right? That, okay, I thought I made the right decision then. I talked myself out of my trade and it would have been so much better. And this is that thing about, one is allowing your losses to get bigger and cutting your profits short is really that piece about, letting your profits run. The message will come across in that type of journaling as well. So.
And that will help you recognize the thought next time. Like if you know what thought that is getting you out of the trade prematurely, then you will recognize it next time and you're like, oh, I'm not going to act on it again, right? I'm not going to be that stupid.
Yeah, excellent. And Peter, I liked your point about, nobody's too experienced to have to journal, and it can always help you. That's coming from you, multiple decades trading. There's people who might say that who are a few years into trading that, it doesn't help them in any way. So that should be maybe an awakening moment for people. I want to ask you guys if there is a current inner game limiting to belief or issue that you're currently working on, and if so, how you're approaching that. Or if there's nothing you're working on currently or nothing really comes to mind, something from the past that you worked through and talking about kind of that process. I think that could be helpful to show an application of the process that you guys have mentioned today.
Yeah, I can take that from my side. There's something that immediately pops up, of course. I can talk actually about the biggest obstacle that I had to get through. As I mentioned at the very beginning, I love challenges, and throughout my life, I've been exposed to many challenges, to the point that, I think a lot of people have some experiences in their life that they had to sort of fight and survive and find their way through, right? So because of the frequency and the type of challenges I was exposed to when I was younger, I just developed a natural ability to survive. My survival instinct was really, really strong. And I made myself believe that I actually liked that. And I started getting a sort of, feeling of pride to, oh, I survived next challenge. But that started developing in my life. Like when I looked back, when I finally started doing the self-discovery phase, I looked back, I discovered that I was actually creating those situations in my life so that I was somehow subconsciously putting myself into trouble to then survive and feel good about myself. So that limiting belief of, which actually doesn't seem like a belief, I love challenges. It sounds like something good, right? I love challenges, but there was this dynamic behind it that I had to overcome and say, well, if I keep creating situations in my life that I have to survive, I will never move past survival. I will never be able to thrive because I keep just ending up at the same stage, right? And a lot of times that in trading, that's what happened. I was stuck in a cycle for 2 years, and every time that I was actually, being disciplined and trade according to the plan, sometimes it was a whole month long. And then on the last day, I would just take out all the profits on the last day and be again at the beginning. So I really had to realizing that dynamic and seeing how I do that, how I put myself into those situations really changed everything. It's just changed the course of my trading. I don't say this was the only limiting belief I had because I had plenty of it, but this was like this one major thing that really made a difference. And I know that a lot of people who get into trading, they say like, why do you trade? Well, I love challenges, right? So it's always good to look at something like, what is it that you really like about challenges, right? Is there any other benefit, hidden benefit or hidden reason why you're actually exposing yourself to an environment like that? So that was for me.
That's perfect. Peter?
I'll answer that too. The reason I tweet, the reason I've been doing that, if you look at my tweets every day, the reason tweet will probably be about something that I'm personally dealing with at that time. Right? So again, just because you've been around for many years of trading doesn't mean you're not human, doesn't mean you're not influenced by things, especially nowadays, like between social media, anyway, it's exciting, right? There's all these things happening. My personal challenges are probably the same as everyone else's, right? Taking profits too soon. And although I think I've got the cutting losses short down pat, and I think to me, that's probably a very critical one that people need to work on. I remember, I forget what book it was a long time ago. I remember them talking about someone that was being trained by a mentor on the trading floor, and they gave him a lesson of, I want you to go out there and I want you to buy a bond contract. And he bought it right away. And then when it was down a tick, he forced the guy to sell it, right? And that was like, and for most people, doing that is such a painful thing, right? Accepting your loss, knowing you're not right, all of those things. But mathematically, if you look at, how you succeed in trading, cutting your losses is such a critical piece of that, right? Just mathematically speaking, right? So the next one is, of course, then letting your profits run and not needing to be right, not taking that profit just because you've got one. And, it feels great, right? When you open up your brokerage account and you've had the market's working in your favor and everything's green and you're like, you look, and oftentimes, again, going back and looking at your previous trades, you'll see that was just the beginning of a move. And meanwhile, you're sitting there taking all this profit and, patting yourself on the back that this was a great day and everything's great. And then, the next day, everything gaps up again, right? You're sitting there not holding anything. So anyway, that's probably one that is a common one for a lot of people, and myself included, but all of these things. But again, after so many years, that whole thing of being aware, and I still say most traders, they know what they're doing wrong, right? Even when they're pressing that button, they're like, I know I shouldn't be doing this, right? So that's the awareness part. But again, being able to deal with it, understand why you're doing it, and change your behavior going forward is what we're talking about today. And hopefully some of these tools will help. But yeah, but to be human, you're gonna continue to do it. Just make sure you do it less frequently, and that the impact is less and less each time, so that you recover quicker, right? So,
and if I can connect to that, because actually a lot of traders who come to me for help, one of their belief is, I should be able to do this finally. I have been in it for so long, right? And that actually doesn't sound like a belief, but it is a limiting belief, because we know that in the market, it doesn't matter how long you are. Actually, the longer you make the same mistakes, the worse it is, because you would just build bad trading habits. So that belief, that like feeling and believing that you should be able already to do that just because you spend so much time in it, that is one of very limiting belief. It just causes frustrations, cause lack of self-confidence, and all the other emotions and spiral. So
Yeah, very good. I really liked the chart that you guys included in the presentation. That was, I forget exactly what it was, but there was kind of 3 different layers. The first is kind of euphoria. I'm feeling invincible. I can do nothing wrong. The middle, of course, is neutral, where you kind of want to stay. And then the bottom is, the opposite of euphoria, very down. I can't do anything right, whatever. And obviously, as traders, with our emotions and as they fluctuate, as our trades progress, we'll be oscillating between these different zones. Do you have any advice or practical tips that you suggest traders when they're either feeling too invincible or feeling too down, to kind of get back to equilibrium, get back into that neutral zone where they can be a little bit more focused and try to follow their rules and be as disciplined as possible?
right. I think the easiest and the simplest, the quickest way to get yourself to the neutral zone is by focusing your attention on the present moment. And there are a few ways to do that. And the reason for it is that usually those emotions that you feel invincible or desperate is because of your dialogue, how you talk to yourself. And of course, the evidence is in front of you. You either had several losing trades, or you just had several fantastic win, and you're just away, maybe, I don't know, from $1,000 profit on a day, and you think like, oh, if I just make a little bit more, and then everything goes down the drain. So being in the present moment helps you to avoid those thoughts and just really focus on what is in front of you. And there are a few ways to do that, and the best way is just to start focusing on your breath. That's where breathing comes handy, and that has actually a function. Not just I'm just breathing before trading. No, this has actually a function, because it brings your attention to the present moment, but also it relaxes your nervous system. So while you're focusing on your breath, there's a lot of different processes happening also on a chemical level. Now, that helps you to avoid your dopamine shot, which is mostly caused by the future scenarios of beautiful life you're going to have when everything goes right, and that helps you to keep your chemical, like being in the present moment helps you to keep chemical balance straight and like where it has to be. And another way to do that is just to focus on everything that's within your reach, like literally just focusing your eyes on everything that you can reach with your hand. So that's scientifically proven that helps you to get away from the dopamine shot and go back here, which is really very important, because the dopamine shots really steers what the thoughts that are coming in. And yeah, the last one would be just, again, staying focused on the present moment by just, even like touching your hands, just do something that grounds you. And it could be like just feeling your feet on the ground and making sure that you are right here. So these are just the very quick things. Of course, the best is to walk away, right? But if you cannot get yourself to walk away, to at least, take your eyes off the screen and reflect on something else that's what's happening in front of you.
I just want to make a point, Richard, about, a lot of people, when they start thinking about the inner game or starting to do work in that, whether they're learning meditation or doing things, they have a real misunderstanding of, they think they're going to trade without any emotion whatsoever, right? They're not going to have any thoughts. They're not going to have any emotions, right? Which is, totally ridiculous, right? We're all humans. We're no matter what, you're going to have emotions. You're going to have that. The key is to be aware of them, look at what behavior that might be making you do, and then countering it. I just want to make a point about, tracking your emotions while you're trading is a great indicator in itself, right? And I know for myself, when I used to, again, get caught up in that, oh, the market's crashing, whatever, it's time to buy a bunch of puts, you want to short some more stock, right? When obviously things are capitulating and it's time to be buying. And likewise, you've made a ton of money, and instead of adding to your long position, knowing that it's time to take some profits, right? So again, you could start to, again, as you're tracking that, and you'll see how many times have you shorted at the low, how many times have you bought a new high, and then all of a sudden it's like, okay, switch that around, and then using it as a tool, a trading tool, right? So more of the outer game of trading, using the inner game of trading for your outer game strategy, right? So just want to make that point, because so many people think it's, you're going to trade emotionless, and that's not a reality. Use your emotions just for you as opposed to against you, and that's
more about building the immunity to the emotions, so that you are not getting like slurred into it, like into a tornado, but not cling onto it, but let it just pass and be able to observe it.
Yeah, excellent. Very good. Yeah, especially when money's involved, there's going to be emotions. So it's certainly important. To end the Q&A, I'd like to ask each of you if you could bring yourself back and talk to yourself just a few years into your trading journey. And Agnieszka, maybe right when you were going through all those difficulties, what advice would you give yourself, whether it's inner game focused, outer game focused? What would you like to communicate to your past self to help? You're not going to solve everything right away, but to help guide yourself, your past self in the right direction.
I would say make sure you have another source of income. I think one of the biggest mistakes that I did was just to quit my well-paid job and put myself under pressure that I had to live off the money that I wasn't making, or I was making and then I was losing. And I think that pressure just adds totally different dimension to trading, and it makes you desperate. And from desperate, nothing good comes in trading, in life in general, but in trading definitely. So you really, I understand that you might want to make it in trading. I mean, I know I did, and it was a matter not so much even about money, but more expectations that I always been successful. I have to make it. So I have to make it. I started putting myself under pressure, so that would be take that pressure away, because really, if there are other ways to make money. Trading is not just one way to give you freedom and independence, but somehow when you are in that struggle, you get into this tunnel vision, and it seems like that's the only way. And just gaining perspective and having another source of income gives you that perspective where you can step back and say, wait a minute, am I really compromising everything around me, including myself, my health, and everything, in my life, just to make this happen? And once you do that, that's where things started going different way for me, taking just the pressure away. I just started feeling different, and from there you can actually start the process of growing. Being desperate is never good, so make sure that you don't put yourself in that situation.
Yeah, that's great. Peter, anything to add?
Well, I think, a couple of comments. One is, again, having realistic expectations, right? So many people, and especially this day and age, everyone wants to become rich instantaneously, and trading is the easy way to do that, apparently. So again, being realistic, I get so many people, "Oh, I've got a $500 Forex account using 400 times leverage. I'm going to be a millionaire in a week," right? So just give yourself a reality check. The other thing too is that there is no, when it comes to the outer game of trading, there is no holy grail. There is no, special, what we talked about today, really finding something that fits your personality, fits your lifestyle, etc. Commit to it, learn it. That's critical. And give it the time to really, go through the learning curve and understand it completely, right? And that it's not going to be a tweak to this indicator is going to make all the difference. It really is about, finding something that fits with you. And then more from the inner game of trading, just recognize how critical that is to your success, right? And don't just ignore it. Don't say, again, just don't focus, just commit to spending some time on your inner game, study it. There's again, just in the last, again, because I've been around for so long, it's only lately that there's been a lot of really good material on the inner game of trading. Wasn't it there before? People just ignored it. First of all, it's the same thing like before. When I started trading, technical analyst was a joke, right? Anyone that was believed that were, that no one, and then now you see there's anything you want to learn about technical analysis out there. Same thing now with the inner game. And again, not only with regard to trading, but just in general, everyone's talking mindfulness. Everyone's talking about, improving their lives from a psychological perspective. So don't underestimate that and the importance of that to your trading, and dedicate time to working on yourself to get there, right? That's, points I would make.
Perfect. Well, thank you both again for your time, for putting together the presentation, and I really enjoyed the Q&A as well. To everybody watching, I hope you guys found this helpful as well and extremely valuable. If you did, definitely go ahead and leave a like down below. Check out the resources mentioned for Peter and Agnieszka, and we'll be right back with the next presenter. So take care and stay tuned. Take care.
Thank you.
Thank you.
All right, welcome everybody to the end, unfortunately, of the 2024 TraderLion conference. First, I just want to give a huge thank you to All right, welcome everybody to, unfortunately, the end of the TraderLion 2024 conference. It's sad that's ending, but I think it's been absolutely amazing. And before I say anything else, I want to give a huge thank you to the speakers. Every single one brought their A game, and I think we've got some amazing resources available now for you guys to review as many times as you wish. And also a huge thank you to yourself, the audience. We couldn't do this without you, and hopefully you got a lot out of the experience. I know it's a lot to take in over several weekends, but go ahead and rewatch things at your own pace. We'll be posting each individual presentation as a standalone video that you can study as many times as you want. Also, if you want access to additional resources, the slides of the presentations, just one more reminder that you can sign up for the VIP via the link that's popping up in the chat right now. And this gives you access to the slides, additional resources, notes that we'll be adding for each presentation, as well as other free resources on the TraderLion website, like model books, special giveaways, classes, the ultimate trading guide. You don't want to miss this. This is completely free. You can go ahead and sign up via the QR code right there. Also, this has been fantastic. We work really hard every year to put on this event. It's my favorite time of the year. And it's, not the only thing we offer here on the channel. We also have regular TraderLion podcasts with top traders, tutorials, free webinars, key clips. We've got so much, amazing material that can help you advance your learning curve and speed that up. And if you're not already subscribed, I highly encourage you to click the button down below. It's completely free. And again, we have a lot in store in the coming weeks, months, and years that we have planned. We're already well on our way to basically reach our goal of becoming the go-to place for trading education. And you don't want to miss some of the resources that we have coming in the pipeline. So go ahead and do that down below. Again, it's 100% free, and we're shooting for 100,000 subscribers pretty soon. And you can help us get there if you're not already subscribed. One more time, I also want to mention a great resource that we'll be creating along with Jason Shapiro on August 24th. He'll be presenting a TL webinar on unlocking the secrets of contrarian trading. He is, of course, a market wizard who is featured in the latest Jack Schwager's book, and he also presented last weekend, and many of you had amazing feedback for him. He really dove deep into his process, as well as you know, how risk management is also his key edge, and he'll be diving even deeper into those concepts in this webinar. You don't want to miss it. It's limited to only 500 live spots. They're going pretty quickly, so you can register via the button down below and the link that's popping up in the chat right now. Don't hesitate, you know, go ahead and do that. This is going to be a tremendous learning experience. And with that, again, a huge thank you to our speakers, the audience. You guys were fantastic. Hopefully you guys got a lot out of it this year, and I look forward to seeing you guys next year at the next conference. But until then, thank you again. Thank you so much for joining us. Thanks for the great questions in the chat and everything. And we'll see you guys in future videos. Take care.